So yeah, we are the multi-factor investing team. So we're going to be going over our factor-based portfolio optimization. So I'm Nate.
I'm Vincent Madden.
I'm Kshitish Bhandari.
So yeah, we're just going to really quickly go over some pretty necessary background, and then we'll of course get into some performance and some pretty cool applications of the results that we got. So starting out, the most important, this is the backbone of basically the entire presentation, is the French model. Specifically, we use a three-factor model. But French in general is an extension of the capital asset pricing model, which is, of course, very well known. Capital asset pricing model aims to essentially explain excess returns with one single factor, beta, as we would refer to it as. French extends on that, specifically the three-factor model extends on that with two more betas of its own. So there's an equation on the screen here that's maybe a little intimidating, but if you look at the right-hand side specifically, you'll see sort of on either end there's an alpha and an error term, which are sort of trivial for our purposes, certainly trivial for purposes of explanation here. The really important things that I want to divert your attention to are the beta factors in the middle. So there's three of them, as I said, and the leftmost one, the market risk beta, is exactly the same beta that we would talk about if we're talking about beta in the context of a capital asset pricing model. So this is market risk beta. It's a measure of how sensitive an equity is to movements in the overall market. So this is something that we're familiar with. If I told you that a stock had a market risk beta greater than 1, then you would expect that it would be more sensitive to moves in the market. Then the French three-factor model extends on this with two betas of its own. The first of those being size. Luckily, these are both fairly self-explanatory. Size beta is a measure of how much a stock behaves like a small cap stock versus how much it behaves like a large cap stock. So with a size beta that is greater than 0, you would expect that a stock behaves more like a small cap stock in terms of its returns than it does a large cap stock. And then very similarly, we have the value beta, which is, again, how much a stock behaves like a value stock versus how much it behaves like a growth stock. In terms of size beta, obviously we have market capitalization is a pretty easy measure for something like that. For value, as a simple proxy, we use book to market, with obviously a high book to market would indicate a value stock. So multi-factor investing, we've employed a model. Right now we have these three factors, these three beta points that we would like to invest with respect to. We have three levers that we can pull, exposures that we can adjust. The question then is, how can you actually invest? How can you effectively invest based on these three factors, get above average risk-adjusted returns, and actually hopefully be able to explain some portion of those returns? That is the goal here, with a special emphasis on explainability, right? We're not looking for just blind high returns. We're looking for a model that produces returns that we can explain. The latter half of this slide then is essentially our end-to-end workflow of this portfolio optimization sort of in a nutshell. So at a high level, we have really two inputs. Raw data, this is just return prices from S&P 500 equities, and then a specific set of three beta points. So these are the three beta points: market risk, value, and size, one for each. And these are presumably the three beta points that we would like to use to build a specific portfolio with average exposure. So if you choose some, for this purposes of the explanation, it doesn't necessarily matter right now what those three are, but the idea is that you input 3 and you output a portfolio with average exposures at or near those targets. So you've input 3 beta points. What happens from there essentially is we regress 3 years of market data, and we fit the equities in the S&P 500 with our own sets of these beta points. So that when you input 3 target beta points, we can actually feed that into an optimizer that will then create a portfolio with target exposures, average target exposures at the three that we specified, and then of course rebalance those monthly to ensure that they stay at those target exposures. And then pretty simply we test. For this we have a 5-year testing period. It's January of 2020 to December of 2024, and the idea is just, well, how does this specific portfolio with these specific exposures perform? So we have a system where you can input 3 beta points and get as an output a portfolio with average exposures at those beta points. I think the natural next question is, how do you choose the best 3 beta points, right? We have the way that we break up the beta points. There's over 1,100 different combinations of beta points. The idea is, how can we choose a specific set of 3 that is, again, has above average risk-adjusted returns and hopefully can explain some portion of those returns. And the way that we do that is with something that is very closely related to something called a bandit algorithm. So the easiest analogy here on the left side of the screen is the slot machines. So if you can imagine walking into some random casino, you pull slot machines, 5 of them, over and over and over again. You're paying attention to returns. And after some arbitrary number of returns, of pulls, you decide, okay, I think on average, machine 2 and machine 4 are paying out better than the rest. And so now you're just pulling these two, right? We don't worry about the other ones. They're not paying out as well. We're just going to pull these two. And again, after some number of pulls, we decide, okay, overall, machine 4 seems to on average pay out better than the rest. And this is at a simple level, this is exactly what we're doing, but you can replace slot machines with sets of 3 beta points. But it's the exact same sort of search, explore, and adjust, where we're testing beta points, seeing how they do, and then adjusting accordingly. A lot of times in the context of a bandit algorithm, you'll hear the phrase exploration and exploitation. That is exactly what we're doing. We're exploring different beta points, and then quite simply, we are exploiting the best set of beta points with the best payout as defined by a risk-adjusted return by building a portfolio that is tailored to those target exposures. Quick note on the bottom of the screen, Sortino ratio is a specific measure that we're maybe more focused on in terms of risk-adjusted return, which is very similar to Sharpe ratio. It only penalizes downside volatility, but you'll see both on the coming slides.
Yeah, so Nate talked about the overall idea of how our bandit algorithm works, but if we want to get a bit more specific, what do our actual periods look like? So you go all the way back to 2014 for our standard period, and you're going to train regression from 2014 to 2016 for the validation period of 2017. Then for 2018, that validation period, you're going to train regression on 2015 to 2017. Then for 2019, you're going to train on 2016 to 2018. You're going to combine these 3 points to get your validation period of 2017 to 2019. And then you're going to get the Sortino ratio out of that validation period, and you're going to rinse and repeat, and you're going to try your new beta combination, and you're going to keep repeating that until you finally have a value that you call optimal based on the Sortino ratio maximization. Now, once you have that optimal beta combination from the validation period, you can now backtest that on 2020. But as Nate said, our period is not just 2020, it's 2020 to 2024. So what are you doing for the next 3 years, next 4 years? Well, you literally just do the exact same thing, but with every year indexed one singular year. So it now turns into a validation period of 2018, 2019, 2020. So it's just one extra year of data. And the idea behind doing that is there's 2 main reasons. One, there's no reason to ignore this extra data. You now have an extra year to work with. It makes sense to try to make your model more accurate by using that extra data. And additionally, overfitting is obviously going to be an issue with any portfolio that's based on historical data. When you have this cross-validation, this walk-forward strategy, that enables you to have a diverse set of information, a diverse set of beta combinations being plugged in, and it's going to significantly reduce overfitting. As mentioned at the bottom, this prevents data leakage, this prevents look-ahead bias, so that typically also will make it even more prone to overfitting. So a system like this, a walk-forward system, does do well to prevent this. Now, we talked about our model and an overview of what are we plugging in, how it's working, but what does the performance actually look like? What is like the end goal of this model that we have? Well, if you start off with a basic ROI graph, you can see the cumulative returns from the period of 2020 to 2024. So a few key things here. You can see, of course, at the top, all the way at December of 2024, we do have a slight amount of outperformance versus the S&P 500. That's obviously a good sign. But you do see some things on here that, eye test, you might be able to see. You see some significant drawdowns compared to the S&P 500, and you do see possibly some increased volatility. Well, when you look at these drawdowns a bit more specifically, the main one that jumps out is the 2020 crash, where you can see our portfolio did, unfortunately, dip down a little bit past what the S&P 500 did. But then, on the other hand, in the bear market of about 2020 to maybe mid-2023, you can see how our optimized portfolio did not dip down nearly as much as the S&P 500, which is going to be a good sign, and that's going to overall reduce downside volatility and help us optimize our Sortino ratio. Now, what the actual performance metrics look like is much better than just blind graphs. You can see we do have a good amount of cumulative return outperformance, and that does translate to a bit extra of annualized returns. Now, on the other hand, you do see a small amount of increased volatility and then a small amount of increased downside volatility. So you might say, well, okay, you just have almost a leveraged portfolio where it's a bit more return-based, but it's also more volatile. Well, the key thing is the Sharpe and the Sortino ratio at the bottom. You can see we have improvements of about 0.02 of Sharpe ratio and an improvements of about 0.09 on the Sortino ratio. And what those 2 numbers translate to is that our optimized portfolio is gaining more risk-return trade-offs than the S&P 500. So for each unit of risk that we add, we're going to have even more outperformance than the S&P 500, which is exactly what we're going for, because what we want is a portfolio that is maximizing Sortino ratio. So when we are beating the S&P 500 in Sortino ratio, that's exactly what we're going for. And for anyone curious, The actual beta points that we rebalance to for each year are the ones as shown. So what that means is for 2020 per se, we rebalanced every month to a 1.3 market risk factor, a 0.2 size factor, and a negative 0.2 value factor. And then it just extends to 2024. Now, we have the performance, we have the model, but our main thing is explaining returns. So what does this look like when you try it on another market? Well, the main thing here is this is the exact same inputs, the exact same flowcharts that we showed previously, with one difference that our raw data is no longer the S&P 500 information and the S&P 500 equity information. It's now based on the Nifty 50 market, which is India's largest 50 equities. Now, why we are doing this is we want to see that if you strip away all the noise, all the idiosyncratic gains of the S&P 500, how well does a multi-factor investing framework really explain your return stream, and how much does it translate into different regimes? So regime changes is a really big thing because in the US, these federal interest rate adjustments, these economic indicators, they're all going to have big implications on US equities. So these changes do somewhat ripple into foreign markets, but the main thing to consider is somewhere like the Indian market, the NSE exchange, it's going to have much less of these ripple effects, and it's not going to be particularly correlated to the S&P 500. So how do our portfolio returns correlate if we ran it on this Nifty 50 market? Well, we would expect that the indexes in and of themselves would have pretty low correlation, and then we're going to expect that once we're rebalancing yearly, it's going to have higher correlation. Then once we're rebalancing monthly, it would have even higher correlation.
So Vincent went over the idea of cross-market correlation. Now we'll see the results. So before moving to the results, we'll see how the Nifty 50 and S&P 500, they both correlate without modeling. So we can see the correlation index is 0.07, which says that both markets barely move together because both the markets share different policies. They have different governments, different investor behaviors. So basically, Nifty 50 and S&P 500, they both live in different financial worlds. So we'll see how does our optimized portfolios on both the markets correlate. So what we did was instead of comparing both the markets simply based on the returns, we put our optimization model on top of them, and we saw that we got a correlation index of 0.73, which is very high, considering both the markets move completely opposite to each other. This shows that our optimization model is not just picking random stocks, and it's actually selecting the portfolio based on risk-adjusted factor returns. So in the next step, we increased our rebalancing frequency instead of going rebalancing the portfolio once a year. We tried it once a month, and it increased our correlation index from 0.73 to 0.85. And this shows that more frequently you realign your portfolio, more similar returns you're gonna get. And this says that our returns are more repeatable and structured. And when I say repeatable and structured, we mean that if we put optimization model across different time and across different markets, we'll get same results and it's the same behavior. So our performance also comes from the systematic factor exposures. It's not just taking random stocks and putting some random noise. So how do we know that our the correlation demonstrate this is that if we get high cross market correlation index of 0.85 on monthly rebalance portfolio and 0.73 on yearly rebalance portfolio. So this says that our returns are basically driven by underlying factors and not Indian and US index-specific performances. Also, our optimization model is doing a good job at filtering out the company-level macro risk and country-level macro risk, and it's basically leaving behind pure factor-based returns. Yeah, thank you.
Can you hear me?
Yes.
Okay. Great presentation.
Thank
The question I had was regarding the window size and the validation set. Is it always a 2-year look back from the validation, or do you incorporate like 2023 to 2016 as well?
Do you mean, I'll go back to the slide. Do we adjust our periods sometimes as to specifically what years we're validating or regressing on?
No, regressing. Like, what do you regress?
We constantly regress on a 3-year period. Part of the reason is simplicity. We do have, like, the system in and of itself does take a while, to be frank, on our computers. So part of the thing that we want to just keep it at a 3-year versus a 5-year, a 10-year, 20-year is just to keep it as simplistic as possible and low computation. And then as far as why not use a 1-year or 2-year, then that's going to be more prone to overfitting and less accurate in terms of how our beta points are fit. So does that answer your question?
Yeah, it just seems like the 3 years a little arbitrary and.
Yeah, I mean, it just kind of comes to the point where, like, that's the smallest size, the least computational size we can use, where we don't see inaccuracies or
What type
overfitting.
of regressions are you using?
Just linear regression.
Hey, good morning, everyone. Hey, you need to flex up a little bit. Good morning. Yes. Thank you, everyone, for joining us for this conference. I'm Edson Bope, and I've been joined with my team here. I'm going to let them introduce themselves.
Yeah, I'm Chikadli Obiora.
I'm Jake Reese.
Okay, cool. So we are here to present the pricing data and risk project that we have been working on over the past few years. Can you go to the next slide? I'm going to pause a little bit on this slide. And as you are seeing this slide, I need you to think about it, right? I have a follow-up question. So right now, as I'm trying to speak and buy time, I'm trying to, getting your mind together so that, like, I think we will have a constructive discussion and presentation on this. If I may ask you right now, what are you seeing? Okay, thank you everyone for those beautiful answers. So what we've been seeing over there is some form of data flow, trying to depict how data flows in the economy. And as you all know, there are those buzzwords and terms that we are all familiar with, including alternative data, right? I think everyone right now at this point in time, I don't know if you could imagine how much data you might be contributing into the data centers as we are sitting right now, as we are presenting, as we are connected to our gadgets. So, as part of this project, the main problem we are trying to address is to price and measure risk information. So, in this moment, you could see that there has been an increase in the need for real-time insights, right? And people have moved from working with more structured data into unstructured data. There's this AI and big data analytics, and now, other than focusing on the figures that we are seeing in the financial statements, more people are now focusing on, like, alternative data and trying to do some ESG, objectives and trying to move their companies in that way. So we have discovered that we no longer have a fit for purpose, way to measure the price of data. And when it comes to size, it's no longer a very good metric to measure data size and try to put a price onto it. Because right now, as you are sitting right there, as you open your laptop, as you scroll over your phone, you are generating almost like 150 gigabytes of data each and every day, and you won't even imagine it. How is that data being used by a lot of companies? So there's a lot of conversations among us that there's issue of regulation, and a lot of economies, a lot of governments have been starting to come up with regulations among data usage and things like that. And when it comes to alternative data, we also have issues to do with integration. How are we going to incorporate that data into our systems? How are we going to convert that data into something that can be used to add value to our companies? And one of the most key variables that is very important when it comes to pricing data is risk. right? So we then try to look at the level of risk that is associated with certain data groups. So you could see that in different economies there are some acts, and there are there are some fees that are charged when it comes to data breach. So according to the AI Act, they charge approximately 7% of your global revenue. And according to GDPR, they charge 4%, and MiCA charges 15%. And I know recently, I think it's like 2 years ago, when Facebook was fined like 1.3 billion due to data breach. And where does that money go? We should be able, since we are the providers of that data, that alternative data, we should be able to get something out of that. So the main focus of our project is not on collecting that data, but our main focus is on risk. There are a lot of companies and a lot of research that has been doing amongst regulation and collecting, like aggregating all the data which is available on the internet, private data, we have a lot of it, but our main focus for this project is on risk. And, okay, next. Yeah, thanks. So as we are generating that information, how best can we try to have a certain control of that information? So we have been working with our sponsor, which is MetaMe. So MetaMe came up with an iCube protocol, which is they tried to aggregate all that information into some iCubes. Those are like your tokenized information cubes that can be put on a blockchain platform. And then you can have some certain level of ownership of that information, and then you can transact with it to everyone who needs to use that information. So as you can see here, I'm not going to go down through the creation of these iCubes, but one of the things that might come into your mind is what are some of the features of these iCubes. And as you know, it's one of those tokens that can be put on a blockchain platform, and it inherently have all those features of assets that can be found on blockchain. So our main focus is on the information cubes that might have visible and invisible data. So on a blockchain platform, or one of these tokens, what you can see is you can be able to find like the metadata of the iCubes, but you won't be able to find the information which is behind that until you transact. So that, you exchange some form of money so that like we can gain something on that. Next. And some of the things that you might not be able to see within those iCubes is these data records. And when it comes to data records, I'm talking about the information that you are generating. It might come into through the form of those like the records that we are all familiar with, like the names, the address, the date of birth, and account numbers. But we can dwell and try to dig deep into some of the information that we might that can be accommodated by these iCubes as well. Next. And these records, they contain a lot of risk. So when it comes to information related to your personal identification, we have a certain risk which is called like identifiability. We also have these kind of risk which include like sensitivity, confidentiality, commercial, and military like risk. And as we dive deep into some of the contents that we might find in these iCubes, we have, some. In as much as an iCube can be big as something that can be used to make big decisions in companies, it can also contain some information which is like pretty granularized, like income, outgoings, savings, credit card balances, and loan when it comes to like a budget control iCube, right? So these are like some kind of examples that we can find on iCubes. And when we think about some of the regulations that governs the data protection, we have the Gremlin Bill Act, and we have the Health Insurance Portability and Accountability Act, General Data Protection Regulations. So we use all these and their findings in trying to come up with the price of risk data. So how actually are we going to be doing this? So this was like a high profile summary of the project, and with my team here, I'm gonna let Chikodili go through this as we progress with the presentation. Thank you.
Yeah, thank you. So we've talked about data, and now we want to bring all these messy data together. We want to make sure what we're giving to the user, what we're giving to the investor, whoever that wants this data, it's properly packed together in order. You find that most of the data you have on Yahoo Finance, on Bloomberg, they all look pretty. Everything is on the right column. But actually, someone did the work to make sure these things were properly put together. So understanding, we started before, let's say we want to provide a data for real estate market. We're able to, we might not do very well, we might not be focusing on the intuition, the strategies the investor might want to explore. But we want to provide data to this set of classes involved. So we'll start from making sure, we'll start from getting a little bit sample from the location or wherever we want to get those study, and then we'll test it, the next one. Then after testing, we'll see if this data is going to capture exactly the intent, our initial motive. Probably the motive is to provide data that helps value investing, or data that help in intrinsic value, or data that helps in some quantitative strategy. So after we get this data, we'll make sure we'll look at this data and see if this data is able to capture correctly everything we need to provide information to this user. Next one. So after, when we do that, and then we'll look back and see if what we did is, if it captured it. If it doesn't capture it, then we might have to find out some other missing parts. So it's actually a very strong intuitive process where we just make sure that we are constantly innovating to capture a market trend, to capture whatever dynamics that is, the market is improving. Just like now we're talking about AI. What is AI is going to look like in next 5 years. We're already studying on such data, providing information to people that this is from what have done in the past. We've been able to develop the future and what AI is going to capture. So try to get this data based on the use cases, based on the weight across different, we understand who is using this, what problem is this solving. You know, we can finally put up data to the user. Then the next one. Then if as soon as we capture this and it looks pretty well, then we can then scale, because we can then scale and start putting this data in the large using API and then doing it in a scalable way, because we don't want to start with that because of cost and economy in business. So the next one, I think that's all.
Basically, with the way we are like collecting all these informations into like an information cube and trying to sell those to companies out there, just to like be able, just so they can make proper decisions. The one big issue that we had with our risk system that was in place that the previous team came up with was that the weights they assign. So the way we do our risk analysis is we every so we have like a bunch of risk categories, and all those risk categories are based on how like a thing performs. So we have like a bunch of high risk items. There could be a bunch of high risk items in your data, a bunch of like low, and a bunch of like medium risk items. So the way our code does is, let's say you pick the investment cube right here, it will count everything that's in the data in the cube. It could be first name, last name, could be social security number, could be the amount of investments you have, or like what you're invested in. And depending on all of that, it basically gives you a classified risk score, which if when it's unweighted, when you just count how many high lows and mediums there are, the total risk comes out to be a medium risk. And when you assign weights to those, it comes out to be a high risk. But the big issue when we started was that the way they assigned weights was kind of by judgment. There was no like code set in place, or there was no proper way of assigning those weights. So as a temporary measure, what we did is we kind of just we put a system in place in Python, which what it does is it counts the number of highs in your cube. And depending on if there's a high number of highs, it assigns, it gives all those metrics a bit of an edge compared to the other ones. And it just increases your risk score. So that's why when we like do a weighted system, you can see like it turns out to be a high risk iCube instead of a medium risk. And it also like gives you just scores of what risk categories affect your iCube the most. So in an investment cube, it's reputation and compliance, because there's a lot of things you need to deal with when you're investing. So that was this is kind of like what the previous team came up with. They had a loss calculation, they had a backward propagation, and this is how they were like trying to assign the final weights. The problem with that was it was all just a bit theoretical. There was no framework in place for that. So this is kind of what me and my team came up with is we create an empirical weighted system for this risk that's in place. So the way we're going to do this is we're going to use multiple sources instead of like the previous just highs, medium, and lows that the previous team came up with. So instead of that, we're going to be using multiple sources to be able to assign weights to these risks. And the way we're going to do that is we're going to assign them into like 5 different portions, being historical incident analysis, expert analysis, machine learning optimization, insurance premium data, and regulatory fine structures. We'll get into that, all of that in a second. But why multiple sources is because previously there was a heavy reliance on, there's always a heavy reliance on weightage, but it was all something that the previous team came up with. So there was no like validation behind it. There was no judgment. It was kind of like what they feel should be assigned a higher score. Apart from that, just getting validation because multiple sources just confirms that you're on the right track. And we also wanted to be able to capture the essence of every marketplace, every person in the marketplace. It could be the market, it could be the regulatory bodies, it could be the people who are buying the data.
So in the expert weighted component, our goal was to replicate human scoring with AI-driven assessments that behave like domain experts, such as lawyers or compliance officers, without actually needing to survey real people in these roles. My current task has been designing and preparing expert simulation agents across ChatGPT, Gemini, and Claude. Ultimately, agents will be reading and interpreting regulation-based definitions from our iCube spreadsheet, evaluating these across 22 risk categories, and then ultimately inputting the agent's responses as variables into our Python risk engine in order to compute a total risk score and ultimately price and classify the data cube. To support this approach, I've been developing a structured prompting framework to guide agents through the survey. The prompt contains background that's needed for the agents to best understand the data set being provided to them, context to narrow their focus, explicit instructions to generate survey answers, and finally, we define the tools available to the agents. Looking into the future, most of my focus is centered around refining and optimizing these AI agents. We'd like to identify the minimum prompt information required without risking producing AI hallucinations in order to keep the prompts both efficient and lightweight. And I also plan to standardize agent output into machine-readable JSON code that can be directly inputted into our Python risk calculation engine. Human oversight can help us determine which agents are performing well in their categories and which ones will require additional tuning. And ideally, we would like to produce 2 data privacy lawyers, 3 information security professionals, 3 risk management consultants, 2 data marketplace operators, and 1 regulatory compliance specialist. Finally, we're trying to incorporate feedback loops into our system by comparing historical expert assessments with the AI agents that are attempting to replicate them. And by doing this, we'll be able to identify when the models are drifting or losing focus of their task. By incorporating this human-in-the-loop feedback system, we're hoping to review survey responses, provide corrections, and slowly optimize our agents.
So another big portion of our risk assessment with the historical incident analysis and the way we do it is we start by measuring the financial impact that these companies have had in the past, and we see what are the primary risk dimensions that were affected. So when the Meta GDPR thing happened, they were fined by the GDPR. The biggest primary risk concerns were they were not compliant. They had a bunch of legal issues, and a portion of it was also geopolitical because European Union has just much better privacy laws than America does. So that was a portion of it. And as you can see, they were fined like 1.2 billion. So what we do is let's say they were fined 1.2 billion. What portion of it was legal? What portion of it was for compliance? And depending on that, we kind of assign different weights to all these, and we then all average it out to one, and that would be 25% of what would affect. That would be 25% of what adds to our weighted risk system that we're trying to build. Apart from that, we still haven't, I mean, it's an ongoing project. The other things that we need to get to is the regulatory fine structures, insurance premium data, and machine learning optimization. The way this works is the reason we do it separately is because there's historical incident analysis just to see what has actually happened. Then there's regulatory fine structures where we'll basically parse through a bunch of regulations, do a deep dive into the research, do a deep dive into those, and just research a bit of what the regulatory bodies think, how the risk should be weighted, because sometimes there's higher penalties for compliance compared to data leakage. So it kind of depends on what it would also capture the essence of what the regulatory bodies think. Then there's the insurance premium data, just like capture the essence of how markets think the risk should be priced for the risk should be assigned for a data. And then machine learning optimization, just kind of like putting all this information into an AI and see what the AI thinks of it and what score it would assign to it, and then like combine all the 5 categories at the end and see how it works out.
Yeah, we want to make sure we're selling this data at a fair price. So, yeah, no one wants to sell below the market. So that is, we've seen what the way Dario said, our brain is essentially like computers. It takes in data, and there's more to think about it. And then we'll have different use cases, but we'll be focusing especially on the REIT, the real estate investment instrument. Next one. Okay. So data can be priced, but the approach we use is basically what is the risk of having or not having this data. So if we are providing a data that is going to provide a lot of resource to you, if we're able to develop a new intuitive strategy in the market, just like what we're working on, which combines what Benjamin Graham has, margin of safety through value, and we had to add a third factor to it, which is intrinsic value. Basically captures upside potential, and it just allows you to explore more upside potential. So if we're able to have this data put in together and we understand the value of this data, we should be able to assign a fair price to it. So that is what we are going to work on. And we also understand the lack of not having this data, what is going to, these are some of the cases where compliance issues and some necessary issues why people need to have this data to properly make better decisions and optimize the efficiency in the market. So, no, previous. So, data is actually, the method we are using to price this data, it looks a bit more like option pricing. Maybe not really like black shows, but we're trying to give you a right to upside potential in the market with this data. But the difference is in the execution. We don't offer the right to execute. So we're going to take that into account, and we'll remove that factor in our pricing. And we'll have some of these different places where this data can be sold. And in pricing, we'll use a risk approach, which when we price our data, we're going to backtest them based on the previous prices we've gotten from this market. We're probably focusing on NASDAQ data link and Bloomberg. So here we talked about the pricing model, which the first one we're using, we assume prices of this data and is normally distributed, and we're going to use this assumption with our risk score. We'll price it and then we'll test it again with through the confidence intervals. We're able to test this data with what we have in the market. If the approach we are using properly captures what is available in the market, then boom, we're going to stick to it. Otherwise, we'll explore probably model 2 or model 3, which uses a different approach from normal distribution. And there are also possibility to use Monte Carlo in pricing this data just to get a fair value. And from the previous work, they were able to determine some prices from using the normal distribution. And yeah, this is what they have. And we'll be studying extensively on having a fair price and using statistical model to price the price of this data. And this brings me to the end of our presentation.
All right. My name is Akshay Kumar, and today I'm going to be talking to you about blockchain fraud detection. Before we start off, I'd just like to mention my sponsor, Alan Frank from Think New Visions. They focus on AI-first strategic technology, and his guidance has been invaluable for us over the course of this project. Now, start off, there's a saying that, when a man stands in a river, right, he can never stand in the same river twice, because that river is not the same river, and that man is not the same man. I think this is a perfect analogy for the current state of the blockchain ecosystem. The players and the market and the assets are all changing so fast that no one is ever standing in the same place twice. As we'll talk about soon, there is an extreme need for compliance and regulation in this space. And given that your space itself is so dynamic, you need regulation that is dynamic and powerful as well. All right, so like I had mentioned, growing adoption necessitates growing compliance. According to recent reports, about 7% of the world owns crypto. In fact, an interesting statistic, and this has more to do with the rate at which that market is moving. CoinGecko published a report in Q1 of 2025 that had to do with the current state of the blockchain ecosystem. And what they found in terms of the creation of new tokens, the creation of new assets, they found that the all-time high for daily creation was 71,000 in a single day. Towards the end of the first quarter of 2025, that number came around to 31,000. Now, to put that number in perspective, 31,000 tokens a day, we're talking about approximately 20 a minute. By the time I finish this presentation and sit back down, you're looking at 400 tokens at that rate. This market is moving so fast that it's extremely hard to regulate and extremely hard to track. And given the rapid acceleration and the exponential rate at which this market moves, you will need equally dynamic and equally powerful compliance. Now, let's begin by talking about what a rug pull is. In fact, before we move on to this, let me turn your attention back here to another statistic. According to a sample that was taken out of the Uniswap ecosystem, they found that 97.7% of the tokens that they sampled out of the Uniswap ecosystem showed signs of being fraudulent. Let's say that number again, 97.7. That's almost all. And in fact, someone who is familiar with this market may not even find that all too surprising, given that the graduation rate for tokens is year after year at or under 2%. Most new tokens fail. Now let's talk about the type of fraud. The most common is a rug pull. So let's talk about what a rug pull is. A rug pull is an asset that is created by a group of people, and it proclaims to have some kind of value. Now, the way it attaches itself to value may be attesting some kind of research. Oftentimes, it's very simple. They tie themselves to some celebrity, a game, a movement, a show. It can be anything. But what they do is they create rampant speculation on this product, on this asset, and that asset is bought by investors hoping to seek returns. And then what happens is the creators drop their support, they sell the asset, and they leave everyone else holding the loss. We can see an example of a chart right here where we had an asset. This is DogeX. In fact, we're going to be going more in detail on this specific asset later that saw a rug pull-like situation. We see a rapid increase in price, and then we see a sudden drop as the creators pull their support. Now, this is an extremely large problem, I think, as we can understand. If the vast majority of assets in a marketplace are fraudulent, the ability to detect that fraud and understand that fraud is extremely important, both for the integrity of that market and as its own investment opportunity. So here I'm going to be going over our solution at a very high level. Now, before we get into this, I would like to say, if you want to discuss this in more detail with me, some of the specific mathematics, the specifics of key things we've noticed during investigations, feel free to come and talk to me during the networking hours. Now, when it comes to solution design, I can go into specifics about hypergraph analysis and specifics about studying volatility curves and stochastic calculus and all of that. But the truth is, under all of the mathematics and all of the data science and all of the programming is a very, very simple philosophy. If it walks like a duck and it quacks like a duck and it looks like a duck, it's probably a duck. What we do, our mathematical models are abstractions of crypto market ecosystems and actual projects and assets. And what we do is we study across assets that are fraudulent and aren't fraudulent, and then we compare what is similar between them and what is not at a very high level. So it's not just a superficial comparison, does one thing look like the other? We are pulling out key characteristics. Now, a little bit about what makes our solution unique for this problem is, one, that it is autonomous, end to end. You have the option to do an entire investigation on an asset or a wallet completely autonomously. It will carry out the multi-hop analysis on its own. It will study the asset's price graph on its own. It will do the graph theory. It will do all of that for you and come back with results. This is really powerful because it democratizes the compliance. It allows for retail investors to also be able to run these kinds of investigations, as opposed to human teams that require a lot of time, a lot of money, and they require a lot of expertise. This is something the retail trader doesn't have access to. You might have seen on one of the previous slides, I mentioned that 17% of Americans with checking accounts have deposited money into a crypto wallet. The retail market for crypto is huge, and this autonomous nature of our solution, I think, opens us up to that market really well. And I would say from there, algorithmic richness and mathematical complexity, we don't just carry out one specific type of analysis. And we don't carry it out on one thing. We look at the asset, we look at the market, and we look at them through different perspectives, through different mathematical lenses. Graph theory, neural networks. There's a large richness to what we do, the kind of analysis we do, and how we compare them to each other. Now, let's talk about some results. Here you can see a very quick example. This is just tokens that I looked at over 1 week. Again, the rate at which these tokens come in and disappear in the market is unbelievable. And here, and the very, very far right, you'll see a risk score. This, in fact, is not our advanced risk score. This is a more simple prototypical measure. But even based off of this alone, we were able to get fairly accurate results on which cryptos were going to fail and which were not. The cryptos that are marked in bright or dark red had an extremely high risk. To kind of put this in perspective, anything above 0.3 is generally considered a pretty high risk. The ones in red and dark red are cryptos that we were almost certain were going to be rug pulls. Now, here in this table, every single crypto you're seeing that was marked in dark red or bright red, every single one of them over the course of this week where I was carrying out my analysis went on to get pulled, losing anywhere from 60 to 99.9% of its value. Now, another point I want to make is that, of course, we can discuss the benevolent motivation for this, which is wanting to improve the integrity of the crypto market. But the truth is that knowing what's going to fail is lucrative. If I can have a way of understanding what cryptos are going to fail, that can be a lucrative thing to understand. There's money in knowing what's about to collapse. And there's multiple ways you can capitalize on that. One example is simple shorting. I do simple shorting, I paper traded basically, and I saw that on these cryptos analyzed right here, if you were to short, you would get a return of around 50% in a week. Now again, given the volatility of the crypto market, that's a qualifier that absolutely needs to be put in. A portfolio like this would have very high volatility, but I think given the robustness of our measures, it could be something very interesting to look into from an investment standpoint. Now, let's talk about a sample investigation. We're coming back to that DogeX token I was talking about before. I'm going to give you an example of very elementary example of what our investigation can look like. So here, we begin with the DogeX price graph, and we analyze its price history. Now note, very important, my analysis of DogeX was done before it collapsed. This rug pull happened in October of this year. That's when I was studying it. I computed all of my metrics around there. Well, you can't see the laser pointer, but around like where it's green. Before that first tiny drop, that was where I first began analyzing it. And it was there that our price model told us that there is a risk of 0.97. To put that in perspective, the risk model goes from 0 to 1. So 0.97 is extraordinarily high. Now, let's talk about some analysis of the actual trading market for DogeX. We create a bubble map, which essentially allows me to just at once visualize who is trading this token, who owns this token, of the people who own this token, who is transacting with who. Now here, in the center of the plot on the top right, we have a wallet that alone, this one wallet, held around 14% of the entire token. This one wallet held 14% of the token. Now, let's analyze these 3 wallets marked in red. All 3 of these wallets had existing reports of fraudulent activity in their past. This is something we see on our investigations all the time. The same organization or group runs multiple different frauds and multiple different kinds of frauds. Exploitation, rug pull, it's a mess, really. It's a menagerie of things. And here, all 3 of these wallets were marked for previous frauds, combining for about 100 reports of fraud. 100. And we, of course, have strong reason to suspect that these wallets are all controlled by the same group or the same individual by analyzing the dates of creation, earliest transactions, things like that. So what can this allow us to say? Well, if we know who the bad actors are, at least we know their wallets, I can create a database of these bad actors. And I can see what future projects they may be involved in. If I'm analyzing a project, I can check it against this database. And I could even carry out a multi-hop analysis, let's say on the market of another asset, and see if in that analysis I catch anyone from here. And again, sometimes you don't play the cards, you play the man. If I know that there's a wallet that's involved in a serial string of rug pulls, and I know that this wallet is now a majority owner in another token, that is another critical sign of failure. Now, to discuss kind of business model, what this would look like packaging all of this up, because the goal here is to do that. This is a service that this market needs. Now, how would we package up this service? Well, it's dynamic. Of course, one way we can combine things is in an API, right? For analyzing price history graphs, this is fairly straightforward. You can provide the ticker if it's available somewhere like CoinMarketCap. I'll analyze it. If not, you give me the price history data indexed by time. I'll do my analysis. For wallet investigations, it can be slightly more complex, but that can also be turned into an API. And of course, we can provide individual analyses. You come to me with a market situation you may have, an asset you're thinking of investing in, a wallet you may need to investigate, and then I can do the analysis. Now, let's talk about a little bit of market analysis. This mainly comes back to this statistic from before, 7% of the world owns crypto. So the total available market over the entire world is huge. Now, if we just cut that down, whittle it back down to informed investors in the United States. So that can include retail investors, it can include institutional, who are trading these assets and who may want to know more about them. That, I think, brings us to our service addressable market. And of course, assuming a 3 to 5% capture of that market, we can get the service obtainable. And here, we make a fairly modest assumption of ARPU of about $20. The expansion strategy, of course, here is fairly straightforward. Like I said, this market is massive, and there's many, many people that have their interest set on this field. So there's government institutions that would like to do this kind of analysis for compliance reasons. There's investment firms, like we mentioned. Failure is profitable. So there's many, many different people, like we mentioned, retail investors. There's a massive variety in the kinds of customers you can get. Now, plans for additional development, we want to do some more open source intelligence. Nowadays, especially with services like Maltego, if you have a wallet and perhaps some additional information, you can actually get some data on the person behind the wallet. It is possible in some cases, and say for an example, like a compliance investigation, that would be extremely powerful. So more open source intelligence integration is what we're looking to do. Of course, we're always looking to expand into blockchain governance, and we're always looking to expand on our current mathematical model, and there's always more research to do. Now, the big picture, right? Now here, to kind of cut to the chase, right? Crypto is at an interesting point. It is both a large market and an emerging market. Rarely do we see a market that is both large and emerging, growing rapidly. Crypto is already massive and it's growing exponentially. Now, we have a market that's growing exponentially. Millions more people are going to be buying and trading crypto every single year. And like we mentioned, the vast majority of tokens that are in this market are fraudulent and require investigation. So now, to safely engage with this market that is only going to grow, we need advanced compliance. Again, millions of people exponentially joining a market where 97.7% of assets show indicators of fraud is probably the best compliance software opportunity of the 21st century. Now, some people may question the morality of making money off of fraud in this way, even if it's secondary. And to those people, I would say, go study ethics, not finance. Thank you very much. I've been Akshat Kumar. I'll turn it back to you for questions.
So what are the time lags between when the coins get launched, you capture the data, and the rug pull? Because you're looking at stuff ex post. So new coin comes out tomorrow, how quickly would you know about it, number one, and then can act on it or make an announcement against it?
So again, here it's fascinating. Many of these coins, many rug pulls happen in the span of just an hour or a day. Many happen in just the span of a day. Coin launches in the morning, has a run, and it's down by 7 o'clock in the night, right? So what I do is, honestly, for this, especially given the graduation rate of 2%, I usually am not looking past a 1 week time frame. I'm usually looking within a week, within a day, and I capture the data and I know about the new coin. This you can do through avenues like CoinMarketCap. You can know about upcoming projects as well, just like you can know about projects that have just began. So I look at projects that have just started today or this week, and then I can carry out my analysis on them in the span of an hour and a half. And of course, given that it doesn't collapse in that time, I can then come back to you with the information and my assessment on both the wallets involved in the market and the returns. Any other questions?
The graph analysis looks very much the relations between existing wallets. What prevents someone just creating a new identity and then issuing the token?
So what prevents someone from creating a new identity and issuing the token?
Yeah, so that it doesn't get caught in the graph analysis.
Well, now here's the issue. Okay, you can create a new identity, and then, okay, I have that new identity, and now I'm using that new identity to carry out a rug pull. I don't want to use my old one. Well, here's the issue. You still need to be related to the asset. See, the funny thing here is that we have millions and millions of dollars moving around in a black market where every movement exists publicly on a blockchain. You can create your new wallet and try to use that new wallet to do the rug pull, but I can still analyze the blockchain of the asset to see who the top holders are. You would need to still be a majority holder even with your new wallet. So you would still come under my purview. And again, the people running these kinds of organizations tend to transact between their own wallets, as you can see here. So if they transact with their own wallet, again, I'll catch them in multi-hop. And the moment they're involved with that asset, I'll catch them by studying the blockchain of the asset, which is usually deployed on Ethereum, the Ethereum blockchain. Does that answer your question? Any other questions? That's totally something I'm going to do. Yeah. Yeah, that's something I'm looking into. There's many avenues here. But again, of course, like I said, with that 50% return, you do have to qualify that this is very volatile, and we'll need very advanced ways of managing that volatility. Yeah.
Yeah, I guess, you're talking about crypto expanding. I don't really know, I'm familiar with Bitcoin. I don't really know about any of this sort of this sort of smaller projects. I guess, in the long run, who is benefiting from this whole ecosystem in general where people are launching tokens, 98% of them are worthless, where, not to get fundamental about crypto, but how is that going to continue being a thing? Who is benefiting from it? Why would people continue to participate? I don't really get that part at all.
Again, it's like any other speculative market. It stops being about value from first principles and true value in the real world, and it starts being about how much can I upcharge for this thing that I bought to someone else who thinks it's going to move up. So it's an extremely speculative market. Now, do we want this speculative market of questionable use to continue growing unfettered, unanalyzed, or do we want to quell and perhaps save retail investors from getting burnt in that market? That's what we're here to do. Now, as for this market as a whole, I guess we'll see. All right, run out of time. If you have more questions, feel free to find me during networking. We'll talk then. Thank you very much.
All right, hello everybody. We are Lehigh University PA 100 Index. I'm David,
I'm Will.
and Ashuntosh worked with us on this project, and we had the incredible honor and opportunity to work with Alex from SIBO Global Markets, who was an incredible person to guide us through all the bumps that we had going through this project. So a little bit about the project. The project was started in 2021 by master's students, and what it is an index of the top 100 publicly traded companies in Pennsylvania. The goal of the project was to get a better understanding of the economic landscape and performance of Pennsylvania as a whole. So our role in this project wasn't to recreate the project from scratch, but to optimize it. And what we did was refine the index methodology. So looking at the steps that it took to rebalance the index and how can we make this easier and more automated for future groups moving forward. So, and just setting the stage for future steps in the process and for future projects as well. So our project objective and why we joined the project was to get a better understanding of indexes and their importance in the financial markets. So indexes are essential in the financial markets because they're just trying to capture the performance of stocks over a series of time, and understanding how to create, construct, and rebalance, and understanding the methodology that goes into that is super important to understanding what is going on in the financial markets. So a lot of what we did was learn how to rebalance it, and then after that, taking the data that we got from rebalancing it and analyzing the reconstitution results. So looking at what companies came in, what companies went out, and looking at the sector trends that happened over the time frame. So what is an index? An index tracks the performance of a group of securities over a period of time. So what I learned about an index is that it's not a publicly traded tool, but it's something that is foundational for a lot of the tools in the market. So a lot of these ETFs are built on indexes, and a lot of the ones that we see are, the S&P 500, the Dow Jones. Some of those are the ones that we see every day that are foundational to the financial markets.
So as it was said, a big portion of it was redoing the project and trying to get a broader view on how we can improve it for future groups so they can come and take over and just keep going along with the project and not have to go back and backtrack. So what we did is we started off by collecting a range of tickers from Bloomberg, and this is sorted in a list that has the sector, market caps, weights, etc. And we also have the state on there, which is what we then use to filter for the top 100 PA companies by market cap. And from there, we then brought that data into our new freshened database. And we also used SIBO, which was given to us through our sponsor, Alex. And we were able to use that data and build out an automated tool to pull in this data, store it, and have a long historical backlog for future groups to come in and use. That was one thing that we added, as the backlog that they had previously wasn't all that rigorous. And now that's something that when we're gone, whoever's up next can use the same data that we had. And going to the market cap, what we did is we used that new data that we could pull in every day, multiply it by the shares outstanding, and that's how we get our total market cap. From there, we calculate an index value, and we also store that as well so future groups can have a historical set of index values going all the way back to 2023 in November. From there, we used GitHub and cron jobs to recursively update this function. how we changed it from the previous group, as the previous group had about 10 days, we updated this to 30. So if there is any issues with the cron job, it has 30 days to be edited, re-edited, et cetera. And that way we don't lose any data, as if you don't have historical data for one day, it really screws with the index, as you don't want to have big jumps or skews. You want to have it as accurate as possible. From there, we also automated quarterly reports on index analytics and performance. We are doing the same thing where we're implementing a GitHub cron job, and this way we could have it run, say, every month, every 3 months, semi-annually or annually. And we'll see some of those new analytics on the future slides. And lastly, we host it live on the PA100 server, and that's on our website, which you could search. If you type in PA100, it'll pop up right there at the top. Now, David had said, we went through a big portion of it was rebalancing the index. So what we did is as we said, we take the 100 biggest companies, we take the weighted shares, and we calculate something called a divisor. Now, this allows us to rebalance without having big shifts where you say the index goes from 120 to 124 in a single day. That wouldn't be ideal for investors or anybody else. So we use a divisor with the function here. And now we're getting into some of the performance metrics. So what we have here is we added some new metrics of rolling correlation with the SPY and a drawdown. And what's nice about this is, once again, all of this is stored on our GitHub going all the way back to late November in 2023. Now, one thing you may see is the performance of the S&P versus the PA100. While we do have a pretty strong correlation, one big thing that's been holding us back is the weightings with the S&P and how big tech has influenced returns. Most of our, in Pennsylvania, you don't have too many tech companies, as you can see in our market weights. So that's kind of what's been holding us back a little bit. But we also have our updated index value chart in the top right, and that comes straight from our website. Now, for future tasks and end goals, one thing that we're looking to do is either create a leverage index of some sort, and that's most likely where we're going to be redirecting this, along with sector indexes of potential sector specific. So AI is the big talk the past 2 years, maybe focusing on an AI Pennsylvania index if there is a large enough sample of companies. Another thing we'd like to do is improve more the data visualization. Previously, we only had really a line graph and a bar chart. And now, as you saw with rolling volatility and some of the other metrics, we're trying to improve that, host that on the website, and make it a little more interactive for whoever visits. And lastly, kind of I touched on in the last point, is to improve the web page and the display and interactivity. With being able to interact with reports, visuals, it's a little bit easier than just trying to read through words or just look at plain numbers and have to read it. Being able to interact, press into it, read the reports, download the reports is where we're trying to transition the project now as we finally rebalanced and settled in.
So an overview of what we did, we didn't reconstruct the entire index, but we refined it, the methodology. So moving forward, it's a lot more automated for future groups. We defined how it worked to document it for the website. And what we achieved, we updated the daily indexes to sector weights and got a lot of analytics and different reports for the project. What's next? And JR kind of just touched on what's next for the project. For this project and this semester, we set the stage for future projects, which we're excited to get started on with Alex. Questions?
A quick question. How is the data being used? You know, where is it being accessed? You know, is it, because I believe this was funded by the state level at some point.
Yes, so as of now, we're using SIBO data for both the prices and market caps. So that data is being stored on our GitHub repository, and we built out a new folder structure to store historical end-of-day prices and historical index values, along with the volatility and standard deviation metrics, which can just be derived from those. But that's all being stored in our GitHub.
Yeah, but who's using the data? You know, outside of Lehigh, is there anyone actually who's accessing this and using it in reports and
the pure
valuations?
The pure price data, no, because it's private in our repository. but if somebody would like to, they could go to the website and download the index values.
Okay, thank you.
Can you hear me? Has there been any thought about trying to do something with private companies? I know inherently there's not a lot of public data on private companies, but I think that's actually something that would be, pretty valuable if there's, any way you could do that. That's data that doesn't exist so readily. Has there been any thought about that?
I would say probably the difficult is, like you said, the difficulty is getting that data and also making sure it's accurate, up to date, and having it track the index. You would need either daily or weekly data in that sense. So somebody would have to be updating that constantly. It is a pretty creative idea though. But that's probably where we would struggle with that, is having to have it come in every single day recursively. Okay. Thank you.
All right, so before we start this, I just want to thank Gaurav Singh, our sponsor at Morgan Stanley India, for mentoring us on this project, and it was very helpful. So, past performance is not indicative of future results. Beneath every beautiful green line, you will see these not so beautiful words. But luckily, investors always protect themselves, right? They learn from their mistakes. They don't get overcome by greed. They make smart, rational choices with the humility that they might be wrong. No, they don't. But can you blame them? Because if past performance is not indicative of future results, what is? Hope? Well, let's entertain the perspective that past performance is always indicative of future results with the idea of momentum. Momentum is the idea that the things that have been happening are going to keep happening. Past trends continue, drawdowns are short, stocks keep going up. It's a comforting story. But momentum has limits. Let's say you had a stock that went up 30% last year. Strong contender for momentum. Maybe you'd buy it. Maybe you'd put it in your momentum portfolio. And maybe you'd get good returns, because you could probably make the case that with a return like that last year, next month it could go up again. But let's say you had a stock that went up 1,000% yesterday. And would you buy it? Maybe you would. But on average, I'd sell it to you, because on average, it's going to go wrong for you. I'll address on average in a minute, but first I want to discuss the concept of reversal. Reversal is the idea that sharp, aggressive trends tend to be punished. Now, with the help of my graduate degree, I've been able to tell you that sometimes things change and sometimes things stay the same. But what's important is I can tell you when. The way I can tell you when is by spending the last 3 months building a completely customizable auto-rebalancing backtester that can account for any ranking criterion, any portfolio rebalancing frequency, and any weighting structure that I want. This is the momentum backtester. So instead of just asking, show me a momentum portfolio, the quants in the audience will want to hear, give me a lagged momentum ranked, equally weighted portfolio with 1 month rebalancing, no outlier elimination, 0.02% rebalancing costs, and 20 stocks selected. Now, in English, I'm asking to search the entire Russell 3000 and rank by lagged momentum. Buy the top 20 stocks, rebalance after 1 month, and repeat the process. Now, lagged momentum is the amount a stock has returned over 1 year, skip the previous month. And the reason you skip the previous month is to avoid reversal problems, which we'll talk about. So, how do we do? Well, we do not too bad for a baseline. The line's going up for a start. After about 14 years, you get around 250% return, which is okay. But the huge problem, as you can see, is we get a gigantic drawdown during COVID that never recovers. And you see an even bigger problem when you add the S&P. This strategy is a terrible strategy compared to the S&P 500. It's more volatile, it performs worse, but it moves in the right direction. So, while we've established the signal is weak, we've established that the signal exists. Let's move on to reversal. For reversal, this time show me a 3-day momentum ranked, equally weighted portfolio with 3-day rebalancing, no outlier elimination, 0.02% rebalancing costs, 20 selected stocks, but this time I want to add 4% margin interest because we'll be going short. This portfolio seems to do a bit better. Let's add our momentum portfolio for scale. And let's make the scale a little clearer with the S&P. So now you can see that this portfolio returns a lot better, 1,000% in fact. But the volatility looks a lot scarier than before. In fact, you get around a 65% drawdown in the middle, which is just unacceptable. So ideally, we'd have a portfolio with the crazy returns of the reversal without the crazy drawdowns. Now, you're always going to have to accept some sort of trade-off, but there's a clue for how to address that in the shapes of these two graphs. If you take a look at the biggest peak for momentum, it corresponds to a pretty large valley for reversal. And that corresponds to about the COVID crash. As it turns out, the reversal portfolio, the COVID recovery. The reversal portfolio loves bad times. If you look at where tariffs come into the graph, there's a huge spike. There's a huge spike again at the COVID crash. And momentum moves in almost a completely opposite direction. This suggests an idea that I've already alluded to, but I'll say explicitly. The momentum and reversal are in some way opposites. Let's see if we can let these two portfolios protect each other. And let's get rid of some lines for clarity. So this is our even-weighted long-short portfolio for momentum and reversal. It performs about the same as the S&P, but unfortunately the volatility is still pretty high. So why would you want something like this? Well, if you take a look at moments in the graph where the S&P experiences a downturn, you'll see that the beta of our long-short portfolio gets jacked up in the negatives like crazy. So this portfolio could possibly add some downside protection to someone that is hoping to expose himself to a market correction. But what else can we do? Well, we can try removing outliers. We can try changing our long-short balance. Maybe we don't want 50-50. We can try weighting by variance. Maybe we can give more or less priority to stocks with higher or lower variance to try to change our returns or our drawdowns. And we could change our portfolio sizing from maybe 20 to 50 to 100 to see how it performs. But as it turns out, we did try all these things. And when we tried them, we found that they all had the same sort of effect, which is that it changes our balance of risk and return. This is a lot to change at once manually. So the next logical step is optimization. So I'll let Casey talk about that.
Kobe is exactly correct. So we have a decent momentum portfolio with even weighting, but there must be some way to squeeze more value out of this portfolio. At Lehigh, we take a class called Financial Optimization, and we learn about the magic of linear programming optimization. And it seems easy, and we should be able to use it. And I'm sure everyone in here has their perfect, hypothesis for what makes a good portfolio optimization. But let's start with just the basics. Maybe your first thought if you're going to optimize a portfolio. Let's optimize returns. I like returns. That's what we're going after. I just want better returns. So let's see how we do. Wow, that is pretty amazing, actually. It looks pretty great. And I love 24,000% returns. Let's see what our portfolio is. It is just NVIDIA. Our optimizer gave us just a pure 100% NVIDIA portfolio. I love NVIDIA, but that is maybe not a great portfolio theory practice. So, we have a couple more tricks up our sleeve. Maybe I want to maximize how much weight we can shift when we're optimizing from our even weight portfolio. We get a nice frontier that looks pretty okay. And let's choose a pretty reasonable value. I'm not feeling too greedy. We can change up to 25% of our portfolio weighting from the even weighting. So let's see how this does. Oh, that is also not great. We get our nice return, which we were aiming for, as we were told, but it is incredibly volatile, especially during things like COVID and tariffs. So, maybe this is also not perfect. But, we're not done here. We can optimize more and more. So let's add another dimension where I'm going to cap the maximum volatility that we can see in a given period. And my graph is getting a little bit harder to read, but it's okay, we're not in trouble yet. And let me just choose a value from this area, again, not too greedy, and all pretty reasonable values. We should get a good return now, right? And we fixed a couple things, like we have better volatility, decent returns, but that drawdown is incredibly ugly and no investor wants to invest in that. So I guess what do we do now? We can minimize the drawdown, optimize for the Sharpe ratio. Maybe we think our sector exposure is the problem here. But the problem is we now have dozens of factors that we can add to this, all to different degrees, And this becomes a very complicated problem. And I guess what's the kicker after all of this? That if we reduce our volatility, we get worse returns? We knew that already. And that's not to say that, all of our back tests were bad and all of our optimization was bad. We have plenty of great back tests from this process. But the point of this project is not to create one great back test using a systematic set of rules. It's to create a set of back tests that are all great and raise kind of the bottom line for an investor. So that being said, one of the simplest ways we have right now that guarantees, some better, more consistent returns is just simple linear combinations of the momentum and reversal portfolios that we had before.
Thank you, Casey. So he's exactly right. There is a lot we can do with optimization, but as we mentioned, there's always that risk return trade-off. And whenever we're changing factors, that is the trade-off that we're accepting. So back to our friendly 50-50, our long short portfolio. It's got a 2.1 Sharp, but it's got a 45% max drawdown, 13.65 average yearly return, not too bad, and a 3.17 Sortino. Basically, our Sortino is saying that for every 1 unit of negative variance, we can expect 3.1 units of positive return, which is not too bad, but again, with a 45% max drawdown, it gets a bit tough. We could change these things, but if we change them, we're changing our risk return balance. But why would you take a risk like this? Why would you expose yourself to a 45% max drawdown? Well, maybe because if you buy this strategy, you're not holding it for a decade. You're only holding it when you think that times are going to be bad. And if you think that the market could be expecting an upcoming correction, this is a strategy that you might want to use. If you'd like to start an argument with someone in this room, ask them if the market is due for a correction. And while you're arguing about accounting fraud, about circular financing, $1 trillion in stock buybacks, PE ratios past 1,500, record market cap concentrations, record auto delinquencies, $1 trillion in margin debt, and record GDP versus US stock market valuations. While you're arguing about all of that, ask yourself, are you willing to place the bet that the near future is as profitable as the recent past? If you are, you're betting on OpenAI paying all 1.4 trillion of its infrastructure commitments. But if you're not, we do have the strategy for you. And you can adjust your risk and return however you want to get the exact exposure you want to an upcoming market correction. But if you think everything's fine, and if you think this graph is going to stay green for another year, and if you think OpenAI's valuation is fair, then I have 8 words for you. And I think you know what they are. I'm Kobe Walmsley. Thank you. So any questions?
What was the short funding assumption you guys made somewhere?
The short funding assumption?
Yeah, like in.
Oh, yes. 4% margin debt on, or margin interest on, actually, I don't need to scroll all the way back.
Okay, and I guess the bigger question is if the idea is you're sort of just putting this on when you think something's bad has happened, wouldn't the real question be this sort of strategy versus just buying puts or something like that?
Yeah, it's a tail risk hedging strategy is what we would be using. I'm sure you could buy puts as sort of an equivalent. It might be interchangeable. We haven't compared it.
Volatility may look chaotic, but today we'll show you that it remembers. Before we dive in, let me ask you, if volatility isn't random, what would forecasting and trading mean? Pardon my manners, I answer to the name Tanya Razga, and with me, I have Sai, who's joining us online all the way from India, Estefanos, and Avinder. We'll be talking to you about realized volatility modeling using FX. On the agenda today, and our sponsor is Rob Mavin, who's from Realtime, the co-founder of Realtime Risk, and he has extensive knowledge in quantitative analysis.
Is it not working?
All right. On the agenda today, we have motivation, why this is useful, our project roadmap, and current progress. So you might ask yourself, what is realized volatility versus implied volatility? Realized volatility is essentially backward-looking, and implied volatility is forward-looking. And the motivation behind our project is the difference between implied volatility and realized volatility creates mispricing in options. And the objective for our project is to build a model that estimates future realized volatility, which is far better than implied volatility. And like all projects involving data, we had to collect and process data. And we had to build statistical tools to validate the robustness of models and then deep dive into the literature and find out what models actually forecast intraday realized volatility, what pricing option contracts do we have, and build trading strategies. And of course, like any other project that involves data, we had to backtest and validate our results. So we started off with data from 2000 to 2021. And after robustic testing and a lot of exploration, discovered that most of the data we had from 2000 to 2011 wasn't really giving us a good result, so we had to eliminate it. And you might ask, why wasn't it giving us a good result, right? Mostly, the major concerns with the models we've been trying to build is looking at realized volatility. How much data do we have that actually fits well with our model without introducing bias and any of the other factors that might make it unrealistic and unreasonable? So we've selected data from 2012 to 2021. And my colleagues will deep dive into the process, model validation, volatility, and try to stay awake for this part, because if you don't ask questions, we'll ask questions. Thank you.
All right. Thank you so much, Tanya. I hope you can hear my voice. Just give a thumbs up.
Yes, we hear you.
All right, great. So let's talk about the analysis which we have started. Let's talk about the returns analysis. Could you please go to the next slide, please? All right. So we have grouped our data into 2-hour data, 2-hour time frame. So in every 2 hour, we kept a threshold of 100. So this means that for every 2 hour, there are 120-minute, 1-minute data. So at least 100 points should be available for each 2-hour time frame. Hence, we consider them as green, if not the red. So if you see the graph, the green ones are the eligible ones which are passing through the 100 threshold, and the red ones are the ones which are not passing through the 100 threshold. Most of the red dots are between the 5 p.m. of Friday and till the 5 p.m. of Sunday, because that's when it's the Euro USD is not being traded. Next slide, please. And if you see, this plot represents the returns over the time 2012 till 2022. And this returns hovers between +2% and -2%. Next slide, please. Let's talk about the returns distribution. This is having mean close to 0 and the standard deviation of 0.14 with minimum -2.61 and max of 1.79. And the skew is -0.09 with kurtosis of 16.18. This is just the returns distribution. Next slide, please. Let's talk about the volatility analysis. Let's see how we have calculated the annualized realized volatility. Next slide, please. All right. So this is the formula which we have used. Let me explain in a bit. I think there's the inverse factor which is missing. Okay, let me explain. The first root, under the root, we have the square of the log returns multiplied by the annualized factor, which is basically we have taken the 2-hour data frame, 2-hour time frame. So that is basically 365 into 24 into 60, 365 days into 24 hours into 60 minutes. by 120 minutes, which is our 2-hour time frame. So this gives us the close to close 2-hour realized volatility numbers. Next slide, please.
Kurtosis of the volatility distribution of Euro USD. 2 hours volatility.
So we have prepared our data, filtered our data, and now we want to perform analysis on this data. And we were looking for patterns, some signals that this data can possibly have. So we first approach we did, we look at this autocorrelation graph. We grouped our data into 100 periods, 100 previous 2-hour volatility periods. And as you can see, it's very periodic. And each 12, so since we are considering 2-hour volatility, the 12th leg is the previous day. But it is like, it is a common thing because New York Open is New York Open every day. So you can expect a correlation. But you can, what you can see here is for the lag one, you can also get, you are also getting a pretty high correlation as well. So what I'm trying to motivate is that the previous period is also can be a good predictor of the realized volatility. Next slide. So again, we tried to build this simple model just using previous period volatility. And this is the fit that we're getting. It's not too good, not too bad, but still you need to consider that we are just using previous period volatility to predict the volatility of next period. And this is the distribution of log ratio error looks like. The reason we are considering log ratios is because we are looking at percentage errors, because the idea behind this is that the error is the magnitude of the error is actually depend on the magnitude of the volatility, and that's why it's a good idea to consider percentage error rather than the absolute error. And again, we'll see in the next slide that we are trying to minimize this error. And previous slide. So as you can see, the distribution of error, it is a much tighter variance when you use the close to close approach, the previous formula that Sai talked about. It gives a much tighter variance and yeah. So yeah, we build our model using just previous period volatility, and now we want to build statistical tools and empirical analysis on this model and see how stable it is throughout the whole period. So again, we use the filtering technique that we use for the data, and we set some certain threshold. Okay, if we have certain number of error counts, we're going to consider only that data. And so we set this threshold to 100. So if we have a log ratio count of above 100, we're going to check stability and error only for that data. And as you can see, the standard deviation, it is almost stable for throughout the whole data. And as I have talked about, you get a much tighter variance if you use a log ratio approach. Yeah. Then Estefan is going to talk about the model that we're trying to achieve.
This is not our model. It might look complicated, but this is QUANT's model. He's a very famous researcher, QUANT, that once worked in Bloomberg. But anyway, the point of this model is to model volatility using two parameters, right? You have your past volatility, and then you have your past returns. Using these two, you can model volatility as good as the Heston model. And our motivation to model volatility is based on this model, right? So R1 represents the returns, R2 is the squared variance or the standard deviation. You put that into that equation, and you can get your volatility. And when I'm talking about past returns and past volatility, it's you're considering the short-term and long-term memory. Okay, so you're not just taking the past return and volatility. So our goal was to build this from startup, from ground up. We wanted to understand how each of the things came together. So we started with an autocorrelation function, right? So what this tells us is how correlated is our past volatility, for this case, our past volatility to our volatility with the current volatility that we have. So lag one basically tells us, okay, the previous period volatility is a good predictor of right now volatility. And basically, you can see that there is some kind of seasonality, and there is a short-term and long-term memory in this plot. So as of now, we're just building a very simple model of QUANT, and we're just taking two volatilities. Okay, let's start with taking the previous 2-hour volatility, and then let's take the previous day volatility, right? And weigh them with some alpha parameter. Let's optimize that, and let's predict volatility. And that's exactly what we did. And using this very, very simple volatility model, our results is kind of fair, I would say. So now we have our model, a very simple model. How did we implement this model? So as I said, we wanted to optimize alpha. So what we did was we grouped each 2-hour volatility predictions that we had into monthly. So we trained the optimal alpha that would minimize our prediction error on, let's say, January over there. And then we tested that alpha on the next month, February. And then we did that rolling to see the stability of this model. That's one of the testing tools that we have. Stability plays a big, important role. And the optimization method that we used was a Newton-Raphson type of algorithm. So yeah, so this is what our plots look like. We have a prediction error of 33%. That is big. We understand that, but given how simple the model is, it shows that these two features plays a big role. And yeah, so moving forward, we plan to actually execute and build up QUANT's model, and look forward to that. Thank you. Yes.
So as you were looking at the data, did you explore any properties of volatility reversion to the mean?
Yes. I mean, volatility always reverses back to the mean.
Yeah, I asked because the equations of autocorrelation don't take into account that that pullback to the mean. And I'm wondering how that would change your results if you looked at it, thinking of something along the lines of a Vazicek or Ornstein-Uhlenbeck process.
The autocorrelation was just to look at the signals that we can get from the data, but as you're asking, we haven't checked anything about the mean reverting property. But the model we're trying to achieve, the Professor Goyon's work, it actually shows that there is a mathematical proof for that it is a mean reverting property if you use that model, just using previous returns. Yeah.
Did you have a look at volatility swap markets, volatility swap data?
No. And you might be asking, why are we doing Euro USD when trying to predict volatility or model volatility? It's because of the data that was available to us. We collected 1-minute data over 12 years. Imagine how big that data is, right? And trying to prepare that data and fix that took a lot of time. So we're only right now using Euro USD 1-minute price data to build this volatility. So, but I would assume if you have that data with the 1 minute, you could just plug it into here, and you can get that volatility, the 2-hour volatility, and then use that into the model that we will be building. Yes. So the answer is we didn't look into the swap data because it's very hard to get that high frequency data.
That you use 365 days instead of trading days.
Yes. So FX has longer, like the trading days for FX is longer compared to like the usual stock market. So if you go back over there, actually. So 252 is used for stock prices, right? To analyze volatility for stock. But FX has a longer trading window. So that's why we use 365, assuming it would be more accurate measure. In this case, this is for stock. It's not reflective of the 2-hour volatility, but it would be 360 divided by 360 converted to minutes, 365 days converted to minutes, and then divided by 120 because we have 2 hours.
All right. Hello, everyone. Akshay Kumar, Ravinder Singh, and Edgar Quadra. We're going to be talking to you about structured product valuation. And again, our sponsor for this is Pierre Lapenois from BNP Paribas, and we thank him, of course, for his guidance and his help with this project. So let's begin with structured product valuations. Well, what are structured products? Structured products are prepackaged investments that combine traditional investments in dynamic ways in order to give the buyer a more customizable balance between risk and return. With things like buffers, upside participation, the buyer has more of a control in the balance between risk and reward as compared to, say, a simple investment. If you're just, say, buying a stock or an option, it's more dynamic. And this is useful because there are many investors that are looking for, let's say, ways to enter the market that have protection against a certain amount of downside, and structured products can provide things like that. So let's just quickly go over what's in our presentation. We're going to be talking about structured products. We're going to be going over the actual minutia of how we combine assets, what we combine, and what is provided in a structured product. We're then going to talk about existing modeling methods like Monte Carlo and the problem with just using a vanilla Monte Carlo. Then we're going to talk about our own methodology. We're going to move into results. And finally, we'll end with a discussion of the implications of some of our work on this market, and then we'll turn it back to you guys. So structured products, as you can see here, come in a huge variety of forms. So not only are they a very large market, they're a varied market. They come in many different forms. But for the purposes of our presentation, we are going to be focusing almost exclusively on auto-callable notes. So coming to the discussion of structured products as a whole, they have they're a large market, like we discussed, all-time high in 2024 of $149.4 billion. This is a 46% year-over-year increase from 2023. So they're an emerging market, they're a large market, and it's, like I mentioned, the motivation is investors looking for more customizable ways, safer ways, often to enter the market. Now, moving on to auto-callables, which are going to be the focus of our presentation and our mathematics and methodology. They are, to put it simply, a big fish in a big pond. The market for structured products is large, and they make up 70% of that market, right? In 2024, they were 70% of structured product issuances. So they, of course, also have an extremely large market cap. An auto-callable note, here you can see a quick example of an auto-callable note where the underlier is LCID, given here, and it's a Credit Suisse auto-callable, and we're going to be discussing more about its structure and our methodology in mathematical modeling, and right now. Now I'm going to pass it over to Edgar to talk a little bit more about the financial minutia of auto-callable notes.
Thank you very much. So let's talk about how these auto-callable notes work, right? We are working first with a zero coupon bond that is going to provide us the face value at which the auto-callable note is sold at. Then we have a digital, also known as the binary option, which is going to give us specific payoffs for when the zero coupon bond can be auto-called. And finally, we have a put option that is going to allow us to give a linear payoff at maturity that is related to the performance of the underlier.
Now, here are some of the features. There is specifically no principal protection. The investors, as I said, may lose up to 100% of the investment at the time of maturity, since that payoff is strictly related to the performance of the underlier. There may be a contingent coupon in some of these autocallable notes, which means that if the underlier is performing at a specific level, you may receive a coupon at any of the observation dates. And then finally, but not least, the autocallable feature. I listed there some of the things that are usually mentioned in the contract, but this is the juice of the whole thing, right? We have a zero coupon bond that is autocallable in itself, but at the time of any observation date, if the underlier is performing at any of these levels, the digital or the binary option as we know it might give us a specific payoff that may give us back that face value plus, let's just say, something like $1. Now I am going to tell you a little bit about one of the problems that we identified. At the moment, the biggest link between an investor and an autocallable note is the private bank itself, known as the issuer. Now, the relationship between the issuer and the investor is of good faith. The issuer usually gives the investor a creation value or mark-to-market price of what they have calculated the structure and the combination of these financial instruments to be, right? And so we also have a very illiquid or almost actually illiquid secondary market in which I can't go on the market and say, hey, I have this structured product, I want to get out of this position. There's no company that's going to be buying it from me at bid and ask, you know? And one of the things with this is that the issuers usually are the ones that go back to the investors when they want to get out of a position, only to protect the price of all of their holdings. And the big problem with this is that I'm providing you the price of a mark-to-market basis, and if the issuers have a Monte Carlo simulation, which we found tends to be noisy, then on a specific day I can have a value that may be 100%, then on another day I may have a value that might be 150%. And so we designed an objective into this project to come up with a variance reduced valuation that we implemented by a truncated Monte Carlo that we are going to talk about in a couple minutes. But this is basically a one-step survival algorithm that we implemented from a paper from Glasserman and Stom. I'm going to pass it on to Arvinder, who's going to tell us more about how we did that.
So, as Edgar had talked about the financial structure of these products, why are they so hard to price? We can use a standard practice of Monte Carlo approach, but the problem with the standard Monte Carlo approach is we have this discontinuous payoff path. As you can see in the structure of our product, we have these observation dates, and at each observation date, your payoff path cuts off. And when you're trying to calculate derivatives around this at this observation date, so minute differences in the prices around this observation date can lead to huge instability in the differentiations, and you need differentials to calculate the option sensitivities. Another thing is again around this observation date, small differences can lead to huge changes in your price estimation, as Edgar had talked about. So these are the two problems with the standard Monte Carlo approach. So what's the solution? What we can do is we can use this GHK importance sampling. Instead of sampling all the paths, we just sample the path that stays below the barrier. And so as you can see, it gives a solution to the problem. Like it gives you stable differentiations around the observation date, and it leads to much more reduction in noise than the standard Monte Carlo approach, around 3 times. So you might be wondering, what about the payoffs of the path, the contribution of the path that actually crosses the barrier? So that's where the trick comes in. So we can analytically add the the payoff contribution for that path that crosses the barrier. This Pj is the probability that the path stays below the barrier, and 1 minus Pj is the probability that it crosses the barrier. So we can add this contribution later on to our payoff function, as I'll show in the next slide. So this is the payoff function of the most basic structure product. It has just one observation date and a date of maturity. So the first term in this payoff function comes from the path that it crosses the barrier. And the second contribution comes from the probability that it stays below the barrier and actually survives the observation date. So yeah, this is about, and now Akshat is going to talk about more on methodology and the model that we have built.
Yeah, so to kind of motivate our discussion of one-step survival and what we implemented from Glasserman and Storm, I think it comes back to what my colleagues were talking about, is that the main issue here is the discontinuity, right? The fact that you can be auto-called introduces discontinuity, and to calculate any kind of Greeks, you need stable differentiation, but you can't have that when you have something discontinuous like this. So what's the root of our problem? Well, the root of our problem is the fact that we have paths that are crossing the barrier, and when they cross the barrier, they get called, and then that becomes a discontinuity. Okay, well then let's solve that problem. We'll just never have any path cross the barrier. Every single path we model in our Monte Carlo will remain under the barrier. We do this by manipulating the random normal variable, the distribution we pull the random normal variable from. Now, the beautiful and elegant thing about this is that we can manipulate that distribution in such a way that we can not only keep our underlier under the barrier, we can do a second thing. We can constantly model the probability of crossing the barrier. So now, in order to understand the contribution from any particular segment, what we need is the probability of crossing the barrier and the constant payoff you would get if you did. And the rest of the model, you can simply calculate using your surviving path, which, of course, like I just mentioned, we make sure that that path survives. By having these two pieces of information, a sample path that always survives, combined with the probability on every sector that it may cross the barrier on that observation date. These two things together allow us to come up with an expression for value that is continuous and easier to deal with than normal Monte Carlo. Now, let's talk about volatility. There is a complex relationship between these kinds of structured products and volatility, because volatility is what creates opportunities for investors, and it's also what creates, a headache for the risk management side of the people issuing these products. So on both the buy side and the sell side, there's a need for understanding volatility and its intersection with the valuation of these products. For this, I think we go pretty traditional. We use HSV. We model the underlier price using geometric rounding motion, and we model its volatility using CIR, because it has to be mean reverting, but it can never be negative, the volatility. So, and you can see pretty clear CIR process there, GBM, and of course you can see the barrier also fairly clearly in that graph. And this allows us to have an understanding of the chance that it may get auto-called on each sector and the overall probability of survival, which is also useful. Now to discuss results, I'll hand it back to Edgar.
Thank you very much. So I'll try to wrap things up a bit briefly. As you can see on this graph, tells you a little bit about the results of our model. Now this is implementing the local volatility, which we talked about earlier. But one thing I do want to say is that we did some back testing, and we found that the absolute difference between our forecasts through Monte Carlo and what actually happened is about 19.10%. And something I do want to highlight on here is that, as you can see in red, there are the contracts for the tickers that actually matured, which means that we actually went back and ran things in parallel with our Monte Carlo and seeing what actually happened to be able to tell, okay, if I have an observation date coming in 1 month, right, what is the probability that that is going to generate a payoff? Now, to be able to calculate the value of that today, I have to discount the payoffs of all the expected paths and bring them back to present value. So that is what we did through the Monte Carlo and also through the validation process to be able to arrive at the present value of what is this specific structured note. Now, something I also want to highlight is for all of these contracts, we created a sort of like arbitrary contract, which all had the same auto call barrier. They had the initial fixing or the initial price of the stock to be the value at the trade date, and then subtracted that by maturity to be able to give you a return at, a payoff at maturity. But yeah, I think that kind of like wraps things up. If you have something to point out, I think there's some interesting points of conversation here.
Yeah, so just to conclude, overall, the implications of this are, again, as we mentioned, structured products are, they're being used more and more every day. It's a way that people like to invest because it offers some kind of safety and it's more dynamic. And I think some implications of our results are having a fair understanding of value, and then perhaps other statistics like Greeks, having stable Greeks. These allow for retail investors and institutional investors to use structured products in a way that I think is more orderly and more quantitative as a whole. So that's us. We'll
Actually,
turn it
can
back
you
to
can you talk a little bit about your sponsors? Yeah, because you had two sponsors on this project.
Yes. So one of our sponsors is, as I mentioned, Pierre Lepenois, BNP Paribas, and another sponsor we have is it's a firm in India that is also sponsoring this work, QUANT Insti, and though they come from a slightly pedagogical background, they also have an extreme amount of interest in creating these kinds of models and understanding the implications of these kinds of models in new asset classes, which is why they're interested in this, and their guidance, of course, has also been invaluable. So I'll turn it back to all of you for questions. Thank you very much.
Okay. All right. I'm Kobe Walmsley. This project was sponsored by Point72 and the genius mind of our sponsor over there, who is incredible. And he also helped us a lot during this presentation. So, I need the clicker.
Hi, I'm Resh Kumar.
All right. So, if you're not a quant, chances are the concept of trading volatility is very foreign to you. And that's okay, because trading volatility is not as easy to conceptually grasp as the idea of trading stocks. It just feels like the thing you're owning is not very tangible. It feels like rather than owning like something you can hold, not hold, but a share of a company, you're owning like a mathematical construct, which just seems a bit nebulous. But the relationship actually isn't so different. If you own a stock, the thing you're really buying, now you own a share of a company, but the thing that you want is the right to the future price move of that company. But if you own volatility, you want to own the right to the future oscillations of the price move rather than the magnitude or direction of the motion. So if you own volatility, a term you're going to see all the time is implied volatility, which is basically how much does the market believe that your stock is going to move in a certain period of time. And the best way to think about this is with this slide where you can see oscillations. If the market is pricing in, let's say, 100 oscillations per week, but then 1,000 oscillations happen and you were long volatility, you can make money. Implied volatility is the forecasted value of volatility that you'll see that determines the price of options. And that gives a clue for how we own volatility at all. We have to use options. And the method that we're specifically going to use to go long volatility is called gamma scalping. But to build to gamma scalping, there's a lot we need to define first. So first, the goal, we want to be long volatility. How do we do that? We start by checking options prices. We want to find options prices with cheap volatility, which basically means the implied volatility that these options have priced in is lower than what we believe or have forecasted will actually happen. Let's use a real example with, let's buy call options on a stock that you think is going to be more volatile than the market says it will be. That's the first step of gamma scalping. So let's use an example from my least favorite stock, Tesla. Let's say that Tesla shares, which already have an exorbitant value for volatility, we think that their volatility is going to be even higher than their value projects. If we pay for volatility now, the volatility is more, we make money. But wait, if we just buy options, we're not just exposed to volatility. We're also in extreme danger from a price move in the underlying security. So we need to hedge our option position, our call option position, with a short stock position. And it's very important that we hedge by shorting the correct amount. And how do we decide the correct amount? Well, we have to look at the delta of the option. The delta is the expected relationship between the option price movement and the stock price movement. It's a ratio. It basically says, at the point you're at right now, if option price moves 50 cents, if the stock moves $1, the option price will move 50 cents. And for extra credit, that means that delta is 0.5. But the problem is, delta also moves with price. And this relationship is called gamma, and hence gamma scalping. And gamma can be a problem for a lot of investors. But if we have a very high gamma, that's good for us. So let's play out a real life example. We start down here at a low price. Our delta is 0.5 and our position is balanced. But then our price goes up. Our delta then moves to 0.6, which means our position is not balanced. We need to change the amount of shares we have shorted to maintain our balance and protect ourselves from any price movement. So we short more stock, and now our portfolio is rebalanced. So this is called delta hedging, and it's very important. We maintain precisely sized stock and option positions to cancel out price moves, and that way we're only exposed to volatility. And now we are truly long volatility. Now, let's look at this in action over a time period. So we start down here. We start at the beginning of the day. The stock price begins to move. The price falls, we buy the stock to rehedge. The price rises, we sell to rehedge. We buy, we sell, we buy, we sell, we repeat. And at every motion during this step, since our portfolio is balanced, we don't have exposure to the price move. So if you look at from the beginning of the day to the end of the day, our portfolio value is exactly the same, but we have bought low and sold high 4 times. This feels like free money. Except there's a problem, because you have to pay for those option contracts up front, and you have to make more money gamma scalping than you did when you paid for the volatility that the options gave you. Your profit has to always be higher than volatility cost. And now we're truly long volatility. So now you understand gamma scalping. But you think, well, let's say we want to realize as much volatility as we can. So what if instead of waiting for some chunky, discrete timestamp to rebalance, what if we rebalance continuously? And we stretch out this Brownian motion graph into a perfectly straight line of volatility that gives us as much money as we can ask for. Well, there's a problem. No matter what Robinhood tells you, buying stocks ain't free. Your transaction costs are going to kill you if you do this. So we have 2 forces at play here. We have the negative force of rebalancing costs and the positive profitable force of rebalancing and capturing volatility, capturing gamma. So how do we balance these 2 forces? Well, what was the title slide? Oh yeah, optimal option rebalancing. So before I let Rich talk about this, I want to address one more thing. To do this process, it's very important that we have extremely accurate pricing data for options, because options data is $19,000 and we don't want to pay for that. And so we can build these pricers ourselves, and this project is still in progress, and that's a lot of the effort we've spent so far. So to talk about the pricing and the optimal option rebalancing strategy, Rish.
Thank you, Kobe. So what are we doing now? Now that we don't have the data, what we are focusing on is building the mathematical foundation. So the way this project moves, it has 3 different components to it. Firstly, we built the American Option Pricer, which will give us a flexible numerical framework to estimate S&P options with early exercise rights. Secondly, we look at the Greek sensitivities, like Kobe mentioned, delta and gamma, to capture the curvature. And lastly, the big goal, formulating an optimal gamma hedging policy that will let us find the optimal boundary where we should rebalance to minimize transaction costs. So before we go into pricing and hedging, what we need to understand is how the underlying asset actually moves. And a good way to model that is the Cox-Ross-Rubinstein binomial tree. So as you can see on the graph on your right side, S0 will be your price at time 0. And what we do here is, instead of using a continuous SDE, we try to discretize into small time steps, which, where you can go either up or down with values. You will be e raised to sigma times square root of t over n, where t corresponds to your time to maturity and n is the number of time steps you want, and sigma is the volatility. And it basically is based on the underlying SDE given on the left, where mu will be a drift term, which will be known to you. It will be the risk rate minus the dividend yield. And this second term, which is sigma st dwt, is the one you're trying to estimate the volatility. And this will give you the up and down movements per time step. This binomial tree, then using the terminal payoff at time t, you can do backward induction and calculate the estimated value of your underlying asset at every time step. Now, getting to calculating the American option at every time step. So the first step would be the terminal payoff, which is basically your intrinsic value, the maximum of your intrinsic value and 0 for both call and put options. And then once you have that, you basically do backward induction for every time step from that to time 0. At every step, we'll evaluate two values. One will be the continuation value, which is basically the discounted expected value if you held that option until maturity. And the other would be the immediate exercise value, which is just the intrinsic value of the option. And using those, you will find the optimal American option value at that point by finding what's the max between continuation value and the immediate exercise value. Now, an important thing to note here is this is only specific to American options because American options give you the right to early exercise rights as compared to European options. And if you look closely to the graph on the right, as we increase the number of time steps, the graph for the early exercise boundary gets smoother and smoother, which basically corresponds to your rebalancing very often. And you have high transaction costs, but you're basically following the same path as the asset. Now, secondly, the Greeks, why this is important. We want to find the delta and the gamma. Gamma will help us measure the volatility. So as Kobe already mentioned, delta is basically the sensitivity of the change in the option with respect to the underlying asset, and gamma will give you the curvature of the delta. And one important thing to note would be delta increases as your time to maturity decreases, as you can see on the graph on the bottom left. And now that we have that, we can finally go to the impulse control problem or the gamma scalping. Kobe basically already touched on it, but what is the problem if we hedge continuously? You incur high transaction cost, you incur the bid-ask spreads every single time you trade. Now, what is the solution to this? So the solution would be to find an optimal boundary where your hedging will be efficient, which means the cost of not hedging will exceed your transaction cost. And that will create a no trade band. So we're still in the process of formulating this impulse control problem because we still don't have the accurate data, as Kobe already mentioned. And so right now we are just focusing on building the mathematical foundation. And as soon as we get the data, we'll be able to try to work on formulating the optimal boundary with also having the right cost parameters like transaction cost and bid-ask spread to estimate what an optimal boundary would look like. And that's all. Thank you. Any questions? Yeah. Yeah, I can start that. I can start that. Yeah. Hi, I'm Rish. Oh. This one.
Yeah, sure. My name is Caleb Johnson, and this is Rish, as you heard, and our project is about detecting pump and dumps on Solana. Our sponsor is Bogdan from AlphaCube, who is in Dubai.
Hi, thank you, Caleb, for the introduction, and a shout out to our sponsor, Bogdan. He was at AlphaCube, which is an investment management company based out of Dubai. So what is Solana, and why are we focusing on Solana? So we've heard a lot of talk today about crypto and the volatility in the crypto space, and why exactly Solana? Because Solana has higher speed than other crypto platforms like blockchain and Ethereum. And just to give you an example, on Bitcoin, the number of average transactions per second is about 7. On Ethereum, it's a couple of hundreds, but in Solana, it's a few thousands. And on the flip side, if you look at the average transaction cost, on Solana, it is only about a fraction of a cent, while on Bitcoin, it could range from a few dollars to a few $100s. Now, that creates a great possibility of high-frequency trading, automated bots, and sniping strategies. And consequently, Solana has become a hotspot for meme coins and pump-and-dump strategies, which we'll try to look at today. And we can just dive into our project.
So while Bitcoin focuses on being a digital currency and Ethereum on smart contracts and being friendly for developers, Solana's niche, as Rish said, is having really low fees and really high transaction processing speeds. So when we first started our project in September 2024, Solana could process 2,400 transactions per second with fees as low as 26 hundredths of a cent. And if you compare that to Ethereum at the time, Ethereum could only process 15 transactions per second, and with fees over 1,000 times greater than Solana at 30 cents on average per transaction. So yeah, what this means is that Solana is the perfect space to have a lot of transactions and to launch coins really cheaply. So the next piece of the puzzle is understanding automated market makers. So what an AMM is unlike on a traditional exchange with bid and ask spreads, it's operated and the price changes according to a formula. So the formula is the amount of Solana in the pool times the amount of the meme coin in the pool is equal to a constant K. And this means that when the AMM starts and the liquidity pool opens, the meme coin is pretty worthless because there's a relatively low amount of Solana in the pool. And with every transaction, with every person that buys that coin and puts in Solana, the price increases exponentially. So when you combine all these factors, the AMM, the exponential price increases, and the cheap and fast transactions, it's the perfect spot to launch a meme coin and execute a pump and dump.
So how do we analyze all these transactions? So our main goal for this project is to classify all the transactions into two big groups, market makers and organic traders. We want to see who the market manipulators are. And meme coins, if you check on SoulScan or DexScreener, which are some analytical tools, you'll see they have highly manipulative trading patterns, are huge. As previous projects already mentioned, about 95% transactions or 98% transactions are only market makers, and about 2 to 5% are organic traders. So for this project, we were looking at two specific meme coins, Wooly and Foon, which were given to us by our sponsor. And there were a total of 8 JSON datasets, 2 from Foon and 6 from Wooly. The Foon dataset was from 17th of September 2024, and the Wooly was from 18th of September 2024. And on the right is a small snapshot of how that JSON file, when converted to CSV, looked like. It had some flags. It will give you the Solana change for every transaction, the specific token address, and some flags, where it was executed. Was it executed on Radium? Or was it a Radium liquidity pool creation activity? What kind of SDK was used? If you don't know, SDK is a really significant factor on determining if it would be a market maker transaction. We used two broad approaches to get to our classification. I specifically worked on machine learning approaches, focusing on anomaly clustering and rule-based scoring to get on to determine thresholds beyond which I would classify that as a market maker. These approaches usually focused on behavioral patterns, the amount of absolute Solana changes, what kind of flags were raised for every single transaction. And I finally used a top K rating to classify the 5% as market makers.
And my approach was data mining. So at a high level, my algorithm starts with randomly generated rules based on features of transactions. I combine those rules into formulas, and then I go through a series of gates to end at a risk score for liquidity pools and assess how at risk they are for a pump and dump. So my rules are a combination of numeric and Boolean. So my numeric rules are using a quantile approach. So for example, one rule might be the time since pool created is in the 95th percentile. And then my Boolean rules are obviously true or false, and these are mostly based on the specific AMM platform that the token was launched through. And then I have formulas that these rules are combined into. So the formulas are a combination of numeric and Boolean. And these formulas, so their goal is to capture between 95 and 99% of transactions. So market makers, as our sponsor said, account for about that much of the total transactions on Solana. So as many as 99.9% of transactions on Solana are artificial, are bots, and are done by market makers. So so my rules and my formulas are trying to capture that sort of space. And the ones that they don't capture are going to be classified as organic traders. So once I achieve formulas that have captured 95 to 99% of transactions and I throw out the rest, then the next step is to look for behavioral outliers. And specifically, I'm looking for outliers in terms of total organic pressure. So what that means is organic Solana change. And this matters because when a pump and dump is executed, it can only be done profitably if there's enough outside Solana that has gone into the pool for the original holders of the coin to get out profitably. So the timeline is the liquidity pool opens, the early holders get in, some bots go through and do some artificial transactions. This gathers retail trader interest. Retail traders buy the token, put a bunch of Solana in, and then it's rug pulled. The original holders sell their holdings and it crashes. So can you go back? Sorry. And the way that I detect these outliers is through the mean absolute deviation based z-score. And this sort of highlights cases where a disproportionate amount of Solana is held by a few liquidity pools and not by others. So the liquidity pools in which there's a lot of organic pressure, a lot of organic traders are putting in Solana. These are the ones that are at risk. These are the ones that are at risk. The ones that no pressure are at no risk for a rug pull because it can't be done so profitably. So I had a few challenges over the course of my project, and the first is that results were, sorry, yeah, okay, I'm gonna start with, never mind, I'm gonna go back to this. The first is that the results were highly subject to the number of transactions that there were. So there were a lot of, so there were cases that I didn't put in that were, sorry. Let me go through this. Okay, so this is an old version of the slide. I'm sorry, it threw me off. I wanted to say that first, I had a lot of, yeah, okay, so at first I had like 1 million rules and I had like a ton of formulas. So I was having CSVs that were 1 million rules and 10,000, thousands and thousands of formulas. And that was taking up as much as 40 gigabytes on my computer. and which is a ton. So I had to figure out how to make those rules more efficient. And what I did is, that I explained earlier is I used a quantile-based approach. So this allowed me to drastically reduce the number of formulas and the number of rules that I needed to use. The next thing that's kind of obvious is I had Booleans in my formulas that were set to both true and false, which was drastically reducing the amount of formulas that were actually achieving that 95 to 99% gate. So I only allowed one rule per formula. And yeah, the last thing is what I touched on. I had, even though I had a ton of formulas and a ton of rules, I was getting no results, which made me have to use the quantile-based approach and change how I did it.
Thank you, Caleb. So as Caleb beautifully defined like how his data mining approach was, but we also wanted to take a different approach to see if our different two methods would corroborate with each other and give us similar results. So as I briefly mentioned before, I used a machine learning approach. And the example which you see on your screen here right now is the anomaly-based classification, where I looked at some specific features like velocity score, which was a helper method which I created, looking at what was the time for different transactions and if a lot of transactions were executed in a burst, for example, in between milliseconds of each other. And some other features I created was a pattern score if there was exactly same Solana change for multiple transactions in a row, and then calculated the z-scores and normalized them to create a score between 0 and 1. And I did the top K classification of top 95% of those to be market makers, top 5% of those to be market makers, and the rest to be organic traders. And the weightage of this classification, my model was 35%, which was completely arbitrary, as that's what I landed on to give it a pretty fairly divided weightage in my model. The second approach I used was clustering. So instead of looking at individual transactions and how far they differ from the mean, I tried to create about 5 clusters, which would look at the similar features, but it would be in a cluster with its own centroid and own mean. And the number of clusters I used 5, but it could be scaled back and forth. From what I heard from my sponsor was it's nice if you have a more granular approach and more clusters, but the ideal value should be between 5 and 8. And the weightage of this classification, my model was about 35% as well. The last approach I had was rules-based classification using heuristics for every flag. For example, like there were some Solana change values which were 74, which is a lot compared to organic traders, which tend to hover around 0.5, 0.01, really tiny values. So if it's a huge Solana change value, then automatically it should be classified as a market maker. And if it's using an SDK, which is an algorithmic program, it should also get a higher market maker score. And using some of these indicators, I would classify which is a market maker and which is not. And this classification had about a 30% weight in my model. So this isn't mentioned here, but after I get all of these 3 individual classifications, I create an ensemble score using the weight, and that's my final classification of who's a market maker. But now going into the challenges of this solution. So first, when we started this project, we had to classify the transactions into different liquidity pools because different liquidity pools had completely separate independent influence and manipulations. And initially, we decided to separate the transactions by the block number, but that turned out to be not correct. And we found out the right way to divide the transactions would be looking at the radium liquidity pool creation flag. And if it's true, that's where our threshold was for classifying the transactions into the different blocks. The second challenge I faced was with clustering. Now that clustering gives you five different big clusters, but not every transaction in that cluster would be a market maker transaction. So what I do is try to calculate the distance from the centroid, but that distance could be either positive or negative. And I don't want negative as a probability, so I take that and use a sigmoid function to calculate values between only 0 and 1 to see, okay, now that I have only positive values, that's my probability score of what could be a market maker. And these are the results we got from 2 of our approaches. Caleb, you can go first.
So I scored by total organic pressure, and I normalized the results based on how many transactions were in the pool. And I had the top 5 liquidity pools by outlier frequency. So how many times was my MAD-Z algorithm hitting certain liquidity pools as having a dominant amount of the total Solana change? So, and then I combined these into a total risk score. So as you can see, my results did line up with Rish's, and these were the 2 liquidity pools that did end up being pumped and dumped.
Yeah, the pool addresses highlighted in yellow were the ones which actually succeeded. And for my algorithm as well, they gave me the highest ensemble score out of all the data sets I looked for that specific token. There are a bit of differences in our results for other liquidity pools, but that's more because of how my algorithm was weighted. But looking at the ensemble scores, it gave us a good confidence that what the algorithm which we are using and the formulation which we have is right. And the next steps now that we are looking at are anti-money laundering projects where we would use similar pattern recognition machine learning algorithms to find what patterns are utilized by manipulative actors out there. But a big challenge with that is these sort of actors tend to change their pattern pretty often. So that would be some of the challenges we'll face in our upcoming project. And yeah, and when we were doing this project, there was, we met with Paul Brody, who was EY's head of blockchain, and he was also really interested in this project because they are banking on Ethereum, and they have the same view as Solana seems to be a hotbed for manipulative transactions, and they also want more evidence out there of the manipulative behavior here. And so that's also what we are going to present to him after this project at some point.
Hey, Rich, who's your sponsor?
Our sponsor is Bogdan. He is the founder and CEO of Alpha Cube, which is an investment management firm based out of Dubai. Thank you.
Yeah, thank you.
Any questions?
So we haven't, and I think we are going to have a conversation during the networking session because our projects are so similar. But I think what differentiates ours is we're specifically focused on Solana. So our algorithms are relying on certain AMMs that are specific to Solana and certain features that are only in Solana and not present in other blockchains. So yeah.
Thank you.
Hello. All right. Forward, backwards, perfect. All right. Hello, everyone. My name is Nick Paddock. Today I'll be presenting my work on Project 45, high-yield ETH-exposed strategies in decentralized finance with our project sponsor, BTCS. This is one of our younger projects here. We just started work on it in September just to get a little more in line with BTCS's current business with their new decentralized finance branch. And so we're essentially looking to find alternative ways to get yield on their large holdings of Ethereum. And with the README we were given, we decided to settle on doing strategies with liquidity provisioning. The active liquidity provisioning is essentially we are going to take some amount of capital, we are going to deposit in a liquidity pool. In this specific scenario, we're depositing our capital into Uniswap. Uniswap is a decentralized exchange where users can go in and swap specific tokens across the liquidity pools, and we're choosing to deposit our assets and provide liquidity to these liquidity pools to enable these transactions to occur without large price slippage and just overall as easy as possible for the users. The way that we actually receive money from depositing this liquidity is by fees. These fees are directly paid out in proportion to the fee tier. Every single one of these liquidity pools has a fee tier on the right. Any amount of volume that moves through it, percentage of that is then turned into fees, which is then in turn paid out to liquidity users based on their amount of active liquidity, which I'll be touching upon shortly. But a little bit more about Uniswap. We're specifically focused on version 3 of Uniswap, which allows for concentrated liquidity. What that's saying is Uniswap v2, if I go to deposit my liquidity in a Uniswap v2 pool, I'm depositing my liquidity across the entire range of the price from negative infinity to infinity, and so is every other user. What Uniswap v3 allows for is for me to choose a concentrated price range. So I can say, this is directly from their website that I pulled yesterday, I can take the current price of Ethereum to USDC, and I can deposit from the current price within a specific band. This example, I'm depositing from a price range 30% above the current price of Ethereum to 30% below the current price of Ethereum. And since my liquidity is now more concentrated, I'm able to be more capitally efficient and earn more fees for a smaller amount of capital that I'm allocating to this liquidity pool. So overall, the Uniswap v3 allows for more mathematics to happen behind the scenes and more capital efficiency, which is what we're looking for, since it allows us to derive higher yield on a smaller amount of investment. So in terms of actually calculating our overall risk and return here, we use this return calculation, which is just the fee profit, which I mentioned is derived from all of the volume that's moving through. We're receiving some fee profit based on that. And then we have the actual change in value of our position. Say I invest $100,000 in capital into this. It is still being subject to price movement in Ethereum if I'm investing on that USDC Ethereum pool that I mentioned. So say I have $100,000 and that's moving as it goes. That change in the value of the position is all accounted for here in the return. And then we have our impermanent loss. Impermanent loss is essentially saying, what is the value of that original $100,000 investment at the final price? So say I invest $100,000, it will not, and the actual value at the end, of that $100,000 is $88,000. If I had just strictly invested that $100,000 outside of the liquidity pool, it would be worth some different amount than that. That price difference is our impermanent loss. And then overall, we have the gas fees that occur. Whenever I mint a position or create a position, and whenever I burn a position or destroy my position, I have to pay some amount of gas fees, which is likely less than $100. And given the returns that we get, it's not accounted for here, but they're small enough that the overall percent error that brings is not relevant to us. Of course, for impermanent loss as well, something to account for is the higher our price range is, the less impermanent loss we face. So if we take a riskier position that's more likely to fall inactive because the price moves, then we are going to be facing more impermanent loss throughout that process. So in terms of some actual a database called The Graph, they have a large amount of blockchain data, specifically for Uniswap. So I pulled in all of our active liquidity data. So basically, how much liquidity is active at that time? Say I deposit $100,000. How much will I be being paid out based on that amount of active liquidity? How much percentage of that active fee will I be garnering? And then, of course, I pulled the fee amount that's paid out every single block. And then as well as that, you need the current price to tell if my position that I'm depositing over is active or inactive, because if the price falls out of the price range that I've deposited over, I'm no longer earning fees. So I pulled this for the aforementioned Uniswap v3 USDC Ethereum pool. It has a 0.3% fee tier. As I mentioned, fee tier. I'm going to be getting 0.3% of the fees and then whatever percent of the active liquidity I have. And I have hourly price data for this. And then it's for the entire length of the contract up until when I started the project. The contract began on May 4th, so that's when I pulled data from. So not the longest span of time, but enough that we were able to get an initial backtest on it. And in terms of our actual backtest, a fully configurable backtest written entirely in Rust, just for the speed. So I can go in, I can say, I want to start at this date. I want to have this set price range for my liquidity provisioning. I want to have this strategy type, which I'll be going into, the 3 strategies that I derive for this. What amount of deposit do I want in dollars? And then it'll automatically translate that into the amount of active liquidity we have. And then overall, we have the returns calculation, as I mentioned, and then we plot our results outside of the backtest, just strictly using Python. So in terms of actually execution for the simulation, from this point forward, we're going to assume that the constant deposit and a constant alpha. All alpha is how we derive our price range. So if I have a 1.3 alpha, I'm depositing my liquidity 30% above and 30% below the current price range. And for when I say a constant deposit, if I am depositing multiple times over our simulation window, say I deposit $1.5 million, at the end of the first deposit, it's now worth $1.3 million. I'll deposit another $200,000 to get back up to that initial $1.5 million deposit. On the right here is a picture of a static strategy. We say for the 120 days that the simulation occurs for, we have our position labeled in green there. So whenever we're earning fees and we're active, the price is within our position and it's listed in blue. And then whenever we fall inactive, it's outside of that green hue and it falls orange and we're not earning fees at that time. So we're looking to optimize for how can we earn the most fees, how can we keep our price range tight enough that we can be the most capitally efficient, but also not fall out of becoming active. So we look at some previously published work here. This is the second strategy I mentioned. They established a tau reset strategy. This is about as bare bones of a dynamic strategy you can get. When I say dynamic, all I mean is that I'm going to be rebalancing multiple times throughout my window rather than just strictly saying over the whatever back test I'm holding one position the whole time. So we have a dynamic strategy here where we say the moment our pool falls inactive, we're going to burn the old position and immediately mint a new one based on that constant price range and that constant deposit size. This, like I said, bare bones, the only thing you can optimize for physically is what price range you're depositing over, what is your deposit size. And since we're assuming that's constant, there's really no optimization for us to do at this point. So we use this as our baseline model for dynamic comparisons. And then in terms of some overall results here, this is for a one-year simulation starting, I believe it's about May, but we actually are using our time in blocks in May 2022, sorry. So our time is actually in blocks. A block is every 12 seconds. So when I say hourly data, I'm saying I have data every 300 blocks. So we simulate over, I believe this is about 250,000 blocks that we're simulating over a full year. And we have a total initial investment of $1.5 million. But then as that price is moving and we need to rebalance up to $1.5 million, our overall total investment becomes $3.62 million. But our overall fee profit at the end we make is $2.68 million in addition to that investment that we get back at the end. So we get an overall APY of 73.37%, while Ethereum performs at negative 32%. So as I mentioned earlier, the overall strategy that we're looking for is how can we avoid against situations like this where we are getting gains on our Ethereum that we're holding outside of just strictly holding it. So this is where I introduce my strategy that I've come up with here. So we have the vol reset strategy, as I've named it, because it's based on volatility. So the previous work, as I said, you can optimize for the what. There's no optimization for the when. You fall inactive, you immediately balance. The idea here is that we are going to optimize for the when. How can we introduce when we want to burn the position, when we want to mint a new position? So I come up with these ideas of three main sources on determining when we burn, and then one main source on determining when we mint. So the project focus is how can we optimize for how close we're falling to inactive, what is our current volatility, and how long are we inactive to figure out when we burn, and then what is the current volatility for when we mint. So overall, I do some hyperparameter tuning. Essentially, I'm going to take 100 different values of price threshold and volatility threshold and run the simulation for all different combinations of those 100 values. I'm going to burn the position if we already have an open position. If our current forecasted volatility is above the volatility threshold, then I'm hyperparameter tuning. And then if our contract price is within price threshold percent of either bound, so if I have a price threshold of 1.03%, say I fall 3% below becoming active, that's when I'll burn the old position. And then I mint a new position if I currently don't have an open position and volatility is low enough that it's time for me to rebalance. So in terms of forecasting realized volatility, I'm just using a heterogeneous autoregression model. It's essentially, I'm just doing a linear regression focused on realized variance because that's not essentially the focus of the project, in the wise words of my boss. If this was a project about calculating volatility, we would make more money doing that. So we use a pretty baseline model here. And this is our overall results. We get the 1.5 initial deposit. We end up depositing total $3.31 million that we make back at the end. But throughout that $3.31 million deposit over a year, we make a total fee profit of $2.94 million. This is over the same simulation window as I had for the previous strategy. So we have the same Ethereum loss. However, if we compare it with the other strategy, we have a smaller overall investment and still greater overall fee profit. And that's because we are staying inactive in the orange during periods of high volatility, which is exactly what we're trying to achieve, is how can we stay inactive during these high volatile periods so we don't fall inactive and face the large and permanent loss or large value loss on our position. So actually comparing all of our strategies on top of each other here, in green, we have the vol reset strategy that I mentioned. Performs well sometimes, doesn't beat the other strategy sometimes. It's something we're actively working on. Like I said, this is a young project. We're going to be handing it off shortly since I'm graduating. But then overall, the idea is that we do outperform the Ethereum performance, which is what we were looking to do to begin with. But as I said, we do have some downfalls here. And it's that we are using hourly price data. ETH is a very volatile asset. And we do have periods where we can fall $400, and that's a 1 hour span. So we do stay active during a long drop here that if we had minute data per block data every 12 seconds, we would be able to avoid this scenario. And that's exactly what a bit of the future work is focused on, is how can we then further optimize for the things I mentioned we weren't optimizing for. How do we optimize the deposit range or the deposit size? How do we optimize the price range? How do we then incorporate different pools? Like I said, we're just working on one singular pool, but there's thousands of pools on Uniswap. They don't have to be meme coin based. They can be something that I could deposit my money into a stablecoin pool, which I'm expecting to trade at $1 because they're both priced at $1. So when I'm swapping between them, they're going to be pretty constant, and I'm going to stay active as long as possible. So these are all things that we've heavily considered that will be for the people we're passing it on to. But as an overall summary here, what we look to do is just create a back tester that can perform liquidity provisioning strategies, which we achieved. And then, like we set out to do, we outperformed long ETH with a volatile aware strategy, and we outperformed our baseline strategy fairly well as well through the volatile aware strategy. And yeah, that's what I got. Questions?
Thanks, because we're running a little bit, unless this is a question, go ahead.
Yes, sir. I don't know.
Okay, that's fine, thank you.
Good morning. We are going to present to you on foreign livestock modeling, and I am Prince Osu Ansa.
I'm Junya. Also,
Our sponsor is Jose Carlos. He has been supportive in this project so far. For today, Our content is going to be the motivation and goal, the end-to-end pipeline of our projects, the data sourcing, feature engineering and labeling, the core models that we have, back testing, and also result and outlook. I believe each one of us would want to catch a football, but none of us would want to catch a falling knife. What then is a falling knife? It is a sharp downward price movement that traders will often want to catch reversals out of it, but then catching them early sometimes may lead to huge losses. That is why we've put together a multi-stage machine learning model to predict signals for reversals. And these are going to be true signals and not just normal noise. So the motivation is to generate automated trading signals with the objective of predicting and also maximizing profitability. The multi-stage machine learning model begins with the signal generation, which is our base model. Then we have our conformal prediction to confirm if the signal that has been predicted is truly the right signal. Then we have the last model, which is our meta labeling, to confirm that indeed there is a probability of you getting something out of it when you trade it, and it helps in also sizing your position. So the machine learning model is going to produce a high confidence trading signal and dynamically going to help you to size your position and also improve your performance. So the end-to-end pipeline is going to be resourcing our market data. We do our pre-processing. We do the actual modeling. Then we have the back testing. So for our data, we use a 1 hour data of Alpha stock from 2013 to 2025. And for our features, in order for our model to have the multi-dimensional market signals, we use both technical indicators and time series statistical indicators. So for the labeling, we wouldn't want to predict just the price of the stock, but then we would want to predict the signal. So we define a label whereby -1 represents a valley and +1 represents a peak and 0 represents in between the peaks and the valley. These signals are not only serving as a normal signal, but they are also helping you show a trading signal as to when to buy and when to sell. Xenia will take us through each of the models and what we've achieved so far.
Thank you, Prince. So after the data preprocessing, we will get the label and features. So let me introduce you how we use the labels and features to generate trading signals. We will use a multi-stage model, as you can see here. First, we will do the feature selection. We select important features for the machine learning prediction, and then use that features as the input features to the base model part. Actually, the base model it is a classification model. It predicts the label. So actually, we can get the trading signal from this part. But in order to increase the prediction accuracy, we add an additional component, like the conformal prediction. It helps us to filtering out low confidence predictions. And then a second filtering model, it reduces the wrong prediction, which will lead to false trade. And the last model is meta model. It is a signal quality assessment model, and it will give us a reliability score. So let's first look at the feature selection part. This plot shows the top 20 features we choose as our input features. We use the Sharpe value. It has the largest absolute Sharpe value, which indicating it has the largest contribution to our model prediction. So we use this as the input features to our base model. And as you can see, we list the input for the base model is binary labels. Previously, we see we have -1, 1, and 0 labels. And at this point, we want to train our base model to focus more on classified label -1 and 1. So we only use data set with label -1 and 1 and drop the data set with label 0. But finally, we want our output has -1, 1, and also 0 because we won't trade all the time. So we add the conformal prediction part. The conformal prediction will help us to filtering out the low confidence -1 and 1 and replace it with 0. And then, so after the base model and conformal prediction, we will get output -1 and 1 and 0. So think of this. We would always have wrong predictions, but not all the wrong predictions are not acceptable. For example, if the wrong predictions is 0, then we won't trade based on that signal. So this won't lead to a false trade. But if the wrong prediction is -1 or 1, we would trade based on the signal. So this would lead to the false trade. So we add the second filtering model. This helps us to reduce the wrong prediction, which will lead to false trade. Our idea is to design another labels so that we can build another classification model. And I can give you an intuition of this model and what is the outcome. So if the base model tells us at this time point, it should be the peak or valley. And the second model can tell us whether it is a peak or valley. If it says it is not that peak or valley, then we can cancel the base model prediction. We won't trade based on the base model prediction at that time. Okay, after we get our final prediction, signal trading prediction, then we want to know the signal is right or wrong. We want to know how reliable the signal is. So we build a meta-label model. The meta-label model predicts whether a trading signal produced by the previous stage is likely to be correct. And we design the meta-label model label as 1 and 0. 1 indicates previous prediction is right, and 0 indicates previous prediction is wrong. So that after the model, what we can get is prediction 1 and 0, which can indicate right or wrong. And then also a probability score, which can tell us how reliable the signal is. With this model, what we can do is to first, we can reject the trade if the probability score is low. And also we can use the probability score as our position size if we want to open a position based on that trading signal. After the multi-stage model, we can get the probability score and also the trading signal. So we use this tool to do the backtest. Our backtest first will evaluate whether the current position has hit the stop loss or take profit threshold. And we use a trailing stop loss. And then execute trading signal. The trades are executed only when the confidence level exit a predefined threshold. As you can see in the plot, there's multi-label probability and signals. The first signal, -1, it has a probability score 0.67. So I think we probably can trade based on this signal. But the next 3 trading signal with only reliability score less than 0.4. So probably we won't trade this trading signal. And when we open a position, we will make the position size equal to the probability score. And every time a position is opened or closed, we track the performance, and finally we'll get an equity curve. Let me show you the final result we get. Here is the equity curve of our strategy and compared to the buy and hold strategy. The orange one is the buy and hold strategy. So I would say sometimes our strategy is more stable, and this is what we are looking for. For example, it's this year, April, when the tariff comes, the buy and hold strategy will face a large drawdown, but our strategy equity curve is a straight line here, which indicates we haven't held any position at that time point. I think this is actually exciting, but we won't know if in the future the market face another large drop, what our strategy would do. But I think we are trying to add more conditions and filtering model, as you say before, to avoid that conditions to happen, or to avoid that situation to happen. In the future, what we are going to do is to improve the model performance by try more different machine learning models and more features and conditions, try different conditions. In the long term, I think we will try advanced trading system, like use long-term signals, short-term signals, and how to combine those, and also more reasonable position sizing algorithm. Oh, thank you. Any questions?
Thank you, guys. Tyler?
Yeah, this is next page.
Perfect, thanks so much.
Hi, everyone. My name is Tyler Rodabaugh, and today I have the pleasure of presenting my systematic trading strategy, Volcanoes. So up front, we have 45 slides in 25 minutes. The math is not in my favor. We will be moving quickly. I will slow down on key items. It gets better the deeper we go. If you enjoy quant strategies and lock in now, this should be a good time. Straddle. This is what we're going to be working with. You got put call, same underlying, same strike. We're going to be vol trading it. That means it's going to be delta hedged. We're going to want our longs to have more realized than implied, and our shorts, we want more implied than realized. Volcanoes, what does that stand for? That's volatility, cross-sectional arbitrage, no extra strings. It's a systematic long-short vol arb, and you could call it a medium-low frequency strategy. We're using monthly straddles here. And I've got a pet peeve with backtests. You got to have the subprime meltdown. You got to have COVID. The headline here, Heston's option momentum allows an investor to harvest the volatility risk premia. You add in two more features that have real-world impact on the distribution of outcomes to form expectations for each straddle, and you've got a stew cooking. You can form a highly desirable portfolio off that. There's a focus on simplicity. Features are analyzed using the Nui West methodology. There's heavy utilization of the academic literature here. You've got Heston, Goyal, Chow, and Bali. Shout out to them. Of course, there'll be delta hedge to minimize that directional risk. The long-short construction will shield from systemic vol risk, and that diversification minimizes our idiosyncratic volatility risk. Does this equal a 5+ Sortino all-weather strategy? Let's up the ante. Can we do that with just a linear model after transaction cost? We will see. So I built the platform out of option metrics with Python. We've got about 1,000 to 1,500 straddles per month that qualify for ranking. To qualify, they have to be approximately at the money with open interest, spread below 50%, and at least 3 months of data that meet that same criteria. I linked that up with the underlying data from CRSP. We've got the price history for hedging and payoffs, got the earnings calendar out of IBES, and of course for validity, we need all the stock splits and ticker changes incorporated. And then for risk research and more enrichment, I added about 50+ stock characteristics. We'll see why the FAMA factors and the industry classifiers are included up front. Now I modeled transaction costs on the straddles and the underlying using Mirovev's paper. Key to this, that 20% algorithmic transaction cost. He finds that informed traders using sophisticated algorithmic execution can average a 20% T-cost. Paired this with delta hedge selection, you can have that daily at initiation, before earnings, periodic, or with a sliding delta threshold. Expectation, you can get that in a linear or non-linear format. And if you want to add constraints, you can have long, short Vega per dollar restriction or enforce industry diversification. And if you so choose, you can make this a dispersion strategy using SPY as your long or short component. Liquidity filters, you take a second to look at those. For spread cost per Vega threshold, I normally use about 3%. Good line there. For feature selection, we're just about to get into that. You've got 4 choices, and you can get those normalized or z-scored. So option momentum, their first feature. It's simply the average of the last 12 months of option returns, and that's the delta hedge return formula. Now, I want to take a moment here and explain how this project came to be. So after undergrad, I spent 5 years doing corporate rotations at JP Morgan. In that environment, it can be hard to stand out. Everyone's good. Everyone gets the job done. With Lehigh's MFE, I saw a chance to transition to a role where the complexity of the problems affords more opportunity to differentiate yourself. So, when Professor Heibe introduced me to Heston's option momentum, and I recognized that it wasn't very well understood, but it was strong. In that, I saw opportunity. I started building last December. Come April, I came to Director Zora, and I told him, hey, I think I've got something. And Lehigh, being the excellent program that it is, he gets me a meeting at 0.72 Hudson Yards to present. And I pitch what I have at that point. It's a one feature, unhedged, no transaction costs, no liquidity concerns, completely frictionless model. And believe it or not, hedge fund managers not too impressed with that sort of thing. Fortunately, there was a head of quantitative research in the room who was familiar with the complexity of the platform I'd built to get to that bad strategy. And in that, he saw opportunity. A few weeks later, he reached out and we established the first sponsorship between 0.72 and Lehigh. Now, I've never been one to follow the beaten path, so having his expertise to establish guardrails on feasibility has saved me countless hours. No shot he has time to watch the recording, but shout out to him. Thank you, Alun. Let's keep it rolling. Second feature, vol level. You may have heard it known as vol premium. It's very well known in the academic literature, that mean reversion effect. And I'm taking implied volatility with a 3-month measure for my HV. My IV is just pulled directly out of option metrics. That's backed out of the Shoals. And my historical vol is the close to close last 62 trading days. Slope, as you can imagine, looking at this without vol level, this one's not going to be too useful. It's the 3-month HV minus the 12-month. Third, idiosyncratic vol. I found this in Chow's paper. It has a really nice monotonic nature to its portfolio sorts, which are going to be key in this model. You can find it in Beta Suite and WRDS. It's actually straight out of the Fama French model. As I alluded to, those portfolio sorts, if you're not familiar with the methodology done here, you can read that D1 as the top decile, so the largest difference between your implied vol and your HV. And if you formed a portfolio off that every month for the entire time series, your mean would be there. And your new US T-stat, you can read that as the statistical significance away from 0. So when you look at the long short of D10 minus D1, that's if you formed a portfolio, longing D10, shorting D1. And when you have a positive new US T-stat on there, in some contexts, people refer to that as alpha. Vol slope, you can see at the extremes, it might have some value, but on its own, not very useful. Momentum, affectionately called MOM, shout out MOM. Idiosyncratic volatility, I've got that I-vol. Check out that nice monotonic portfolio sort on both these guys. That's going to be essential. Everything after this slide is going to be after transaction costs. It's going to be 30 longs, 30 shorts, that 1 month holding we've discussed. Everything's daily delta hedged. We're not going to enforce any additional constraints. On our left here, we have the linear model and the features used in it. In white, you have your Nui West T-stat for the monthly return. Sharp, Sortino, and max drawdown have been highlighted. As mentioned earlier, you can see that slope on its own does not have much value. Bull premium looks like it's got something there. But when you put them together, you see the value, including slope in this formulation. It becomes much stronger, and that reflects in the Sharp, Sortino, and max drawdown as well. Next, I draw your attention to bull level, which is more well known than momentum. However, momentum, much more statistically significant. Better Sharp, better Sortino, better max drawdown. Let's look at the best 2-feature, 3-feature, and 4-feature models. You can see they improve as you go. And I want to deliver here. There's your 5 Sortino after algorithmic transaction costs with just a linear model. Next, if you're more of a visual learner, check out blue vol premium, orange momentum. Notice how vol premium, up until 2012, you could get away with a single variable regression model if you had everything done right, but then you're just bleeding out transaction costs. But momentum in orange, it's got that tortoise in it, slow and steady. You make it a little bit more sophisticated, you add slope, you get that green line, and you run that. Well, you can get away with that till about 2015, at which point the market gets more efficient. You run into the alpha decay problem, and we'll get into that in a second. You need to have momentum to keep it going. You might think, looking at the yellow line and the light blue, do we really need that 4th feature? If you're familiar with log scale, you know what happens when it drops. Yeah, you do. It's a huge difference. The 4-feature model is what's really kicking here. That alpha decay, take a look at how long that vol premium works and how it drops off very rapidly. You add in slope, you get away with it for a little bit longer, but then you're going nowhere. Compare that to the 4-feature model. Now, what could have happened in 2017 with the 3 features being volatility related that would make this model underperform? The VIX was bumping off record lows all year. There wasn't a lot of differentiation in those vol features for the model to pick up. Moving into a more granular view from annual to monthly. You can check out the time series here of that 4-feature linear model. You see it's a little bit weaker in 2017. Again, I ask, what happened in mid-2013 that could give it the worst month performance it has? That negative 14% drawdown. Familiar with the taper tantrum? Ben Bernanke announced the end to quantitative easing. Caused a lot of vol strategies to underperform during that time and in the months after. If you're comfortable with the complexity of a nonlinear model, you do get rewarded for that. An XGBoost formulation with these features, even though there's only 4 in the normalized, there's not a lot of nonlinear activity to pick up on. It does outperform significantly. You do get rewarded for that. An overlay of that nonlinear model, the XGBoost, and the multivariable. you may notice that the XG boost has a lot more conviction in its positions. It typically has stronger highs, but it also draws down deeper when it does. We'll see in the metrics, those risk return ratios, if we actually should move to that nonlinear model or not. Check out the skew of the monthly return series on this guy. And that kurtosis, that's in your favor. Again, this is all after that algorithmic transaction cost. There is no evidence of crash risk in a 2-decade backtest. Let's take a look at it by the numbers. We'll focus on the 4 feature models, the linear, multivariable regression, and the XG boost. When you take a look at the Sharp and the Sortino, yes, you do get rewarded for that little bit of extra vol. You get enough return where by the stats, it looks like it is in fact worth it. The Colmars, it's unheard of. So model risk, we do have a time travel problem in this model. Like in a lot of academic literature, I'm using closing prices. And I'm assuming that I can form next month's portfolio simultaneously as the prior month expires. In reality, you need to wait for the capital release, put in the orders the next day, whatever. Data source look-ahead bias, it's possible. I'm syncing up a lot of data here from a lot of different sources. One of them could have some future data leaked in. Survivorship bias, say a stock gets delisted or taken private. Given the long-short construction of this, I think this is probably a lesser issue. Take a look at this under the hood of what the nonlinear model is picking up, the positions it takes on over this whole 22-year backtest in this case. Shorts are in orange or longs are in blue. It would be fair to ask, are you just picking up the liquidity premium with this one? I would push back on that and suggest no. This is an aspect of the momentum phenomenon options. You've got less informational diffusion on these smaller cap stocks, which makes them more likely to have that mispricing. And that informational diffusion difference comes from them having less institutional ownership, less analyst coverage, less public interest in general. And I'd support that claim by showing you the open interest of the positions that get picked up. Note the difference is not that big. And this makes sense given our expectation formula accounts for the anticipated transaction cost when forming the portfolio. So a small cap stock that has a large bid-ask spread wouldn't get included in the first place. Again, looking under the hood of the nonlinear model. It looks like it picks up a lot of healthcare. Why might that be? What is unique about these healthcare stocks in terms of vol? Well, you've got a lot that just bleed out cash until they find something. You've got regulatory risk, you've got drug trial breakthroughs. It's a pretty unique sector. But as far as the systematic risk that this poses, I can tell you in the months preceding and post the American Affordable Care Act, there's no discernible difference in the performance of the strategy. Even within the healthcare sector, there's diversity of stocks. And given the overall diversity of this portfolio, it does not seem to be a concern. A production system, I'm in the process of merging this with Polygon to get up-to-date information. I'll be using limit orders based on the acceptable vol price in IBKR, what the model gives me. And now there's a flexibility advantage to this. We've been talking about the top 30 and bottom 30 positions. If, however, we can get price improvement deeper in our expectation ranking, it can be just as good. Now, paper trading will be great to validate the execution and delta hedge algorithms, but there's going to be a deficit on fill prices. With paper trading, you don't get access to the order book depth, so we won't actually know where we fill. And now that's a major problem because this strategy is transaction cost sensitive. And what I'm trying to illustrate in this poorly scaled graph here is that the more transaction costs you're willing to take on, the higher your probability of execution will be. And as you go deeper in your rankings of your orders, the further down, the less likely you have for probability of execution. And given this, as we increase the portfolio size, the market's going to move against us. We're going to shift down on that probability curve. Knowing these factors, what can we expect in a go live scenario? Well, we're not going to be able to stuff 100 million in this and get $70 million a year back. Like, it's absurd. Maybe, if you believe Mirabev's paper, we can get 100K at that 20% effective TC, moving to 50 TC at $1 million, and maybe we end up at 75 TC with 10 million. It's hard to speculate. So what could the opportunity here be? Well, if you take a look at the 5 largest market drawdowns for the SPY index and how Volcanoes, the algorithmic formula, performed in that time, you see it's an uncorrelated alpha. So even at that 75% TC, you still have a 1 sharp, 2.5 Sortino. If you were to merge this, if you were to diversify between the market index and some Volcanoes, you'd improve the overall risk profile of your portfolio. Now, there are other straddle features in the academic literature that have that nice monotonic portfolio sort nature. With access to institutional quality data, I believe I could curate those and push the capacity of this strategy out further, potentially positioning this as something that a hedge fund would have a good deal of interest in. Some closing thoughts. This project has brought me a lot of joy. I've been working on it for about a year now. I'll burn entire weekends opening up the optionality, adding position sizing, regime modeling. Sometimes I'll grid search that whole thing when it's opened up. When you're looking at the thousands of models that come out, you can find a model that easily performs better than Volcanoes. What I love about Volcanoes is 4 features normalized 0 to 1 every month, and a linear model is all it needs to kick. I find beauty in that simplicity, and I'm glad I got to share that with you all today. Thank you. Oh, Q&A? Anybody? You can find me after and talk about it.
There we go. Very beautiful. All right. First, those were excellent presentations. You should all be proud of yourself. You're bringing a lot of insights and rigor into problems you're going to face, and the resources that Professor Zorro and Lehigh are affording you are immeasurable. I'm actually jealous because I didn't have this when I went to Villanova years ago, and just take advantage of it and immerse yourselves in the problems and the resources you have, and it's great. I really, you guys are 10 times ahead of where I was at your age, and keep it up.